Well, good morning, good morning, good morning. It is Saturday, July 27th, and we are here to do the Credit Spreads Masterclass. We're here for the Masterclass. Um, yeah, I'm so excited about, first of all, teaching credit spreads because credit spreads is our jam. We love credit spreads. We trade credit spreads all week, every week. It's just what we do over here. I am totally convinced that credit spreads is one of the best ways to grow a small account. It's one of the best ways to learn to be a trader if you're new because it doesn't have a lot of moving parts. I think it's one of the best ways to utilize your collateral and not have to watch your screens all the time, not have to have a perfect entry or a perfect exit. I think credit spreads just offer so much versatility. It allows you to trade bigger stocks that you may not be able to trade if you're just going straight buying. I mean, I just see there's so many possibilities. Okay, so that's why I love credit spreads and I like to share it with the people. Okay, so today we're going to learn to use credit spreads for consistent profits. All right, first of all, I want to say welcome, 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 welcome. I'm so glad to have you here. So glad that you chose to spend your time, your energy, and your money with me. There's other places you could have been. There's other people you could have traded with. There's other folks you could do this from, learn this from. I get it, but I appreciate you, and I want you to know I appreciate you. Okay? So glad you are here. Okay, I am Arlissa. I'm Arlissa. I am a mechanical engineer. I graduated from Tuskegee University back in 1992. Mm, mm, mm. As I think about that, 32 years ago, I was graduating from college. So yeah, I'm a mechanical engineer from Tuskegee. I'm a math professor. I'm currently doing that. I teach at the University of North Florida here in Jacksonville. I am an entrepreneur. I'm the owner of Pinkleton Enterprises, which has several subsidiaries, Educator Trader being one of them, Melanin Inspirations being one of them. And anyway, I'm an entrepreneur. I'm a digital creator. I do all that stuff. I'm a stock options trader. I've been doing that for about 4 years. Been doing that mostly as a seller almost all that time. And I've learned a tremendous amount in that period of time. Do I know it all? Absolutely not. Do I know more now than when I started? Absolutely so. Yes, yes, yes. I'm the head coach at Educator to Trader. I'm not the only coach, but I'm the originator, creator of Educator to Trader, and we just doing what we do. We're making it do what it do every day. I'm a content creator. I'm a wife. I'm a mom. I'm a grandma, and I am a great grandma. I actually have 27. We have 27, at least 27 grandchildren. Every time we talk about it, I say 27, my husband will say 25, and sometimes I say 28. It's around there. We got 12, I want to say, great grandchildren. And this all comes from, I have two children by birth. My husband has five children. We put those together for our seven, and that's how we got all those kids and grandkids. Even though I only have one like natural grandchild, one from like biological, I have one. So all them other 20 something, those came from Mr. P. Those came from the Mister, okay? I see a message popping up over in Educator to Trader. Let me make sure that's not somebody over there trying to get in. Oh, that's you, okay? We're on Zoom call, try to inbox you, but it's disabled. Okay, so Jamie, go into our main group and tell Mr., like send a message to Mr. Earl inside the main group, inside of the Educator to Trader. I don't see his name there anymore. Maybe that's the deal. I'm trying to find him. I don't see him there either. Hold on, you all. Let me see if I can find Mr. Earl. I see him. Hold on, everybody. Hold on. Just a little while longer. Hold on. Just a little while longer. Hold on. Just a little while longer. What's the rest of the song, Janae? It's going to be all right. I think Janae said the back of it was something like that. I don't remember. I always start the song and then forget the rest. Doesn't that happen? Doesn't that happen? Okay, so I was talking about being a wife, a mom, a grandma, and a great grandma. Basically, you see all my socials here. I'm educator to trader in all the places. And basically, I'm just regular old folks who are here, who's out here in these stock option streets, trying to make sure people can get this money, because I am also convinced that the stock market is one of the best places to generate an income. It doesn't require, products. It doesn't require more people. It just really requires a Wi-Fi connection and your ability to push the buttons. That's all you need to have is a Wi-Fi connection and the ability to push the buttons. All right. So, question, are you ready to level up your trading and investing? Tell me in the chat if for selling options, let's go with credit spreads and selling options. If you're completely new to selling options, don't have an idea, don't know at all what you're talking about, put me a 1 in the chat. If you know some stuff about, something about credit spreads and selling options, a little bit or some bit, put me a 2. If you're really good at credit spreads and all those things, put me a 3. Put me a 1 if you don't know, anything at all. Put me a 2 if you know some, want to know more, and put me a 3 if you are, I got this. I probably could teach this class, Arlissa. I could do this if it was me. Right? Oh, I got a lot of 2s. Wonderful. Wonderful. I see Sean, I got 1. All righty. You got to lean in close early, Sean, so that way you'll catch up all the pieces that you don't know yet. Okay. Cool. I got a lot of 2s. Wonderful. Wonderful. This is good. Lisa's here. All right. So here we go. Our disclaimer: this is not a solicitation to buy or sell any security or any options contract. This is not investment advice. I am not a financial advisor. The market is not easy to predict. There's going to be losses that are taken along this road. We really count them as the cost of doing business. If you run a business, you're going to have some costs if you run a business, right? Stock market's not easy to predict. I'm not responsible for any losses. I would be excited if you had lots of wins, but I won't take responsibility for those either. Everybody takes full responsibility for everything you do as a result of this information. Basically, you are the CEO of your own portfolio. You're the CEO of your own portfolio. All righty. What you will learn in this masterclass: you got the basics of option selling. We got put credit spreads, call credit spreads, charting for spreads, picking your strikes, entering and exiting your trades, more money with iron condors, finding the stocks to trade for spreads, and using Peakbot. Really, there's a number 9 down here that is like the wrap up. And where do we go from here? I don't know why Mr. Earl can't seem to get. Jamie, tell him to go check in his own group. I sent him a message. Tell him to scroll up into, scroll in Telegram. Because I've sent him a message on Telegram. Okay. That's what we're going to learn in this masterclass. Jamie will work, Mr. Earl. Thank you. Basically, option selling basics. When you're selling options, you're entering as a writer. It's called a writer. You may have seen something where it says writing options. Sometimes if you're, depending on where you are, you'll see the word writer. When you're selling, you're a writer. You're basically opening and closing a selling contract. Most people who know about options know about buying calls, buying puts. Most people know about buying. Selling is the other side. If you're buying a call, somebody is selling you that call. You may never know the person because, of course, the people in the middle, the CBOE or whoever is the exchange people in the middle, they connect the buyers and the sellers all together. But if you're buying an options contract, somebody is selling it, right? It's not just of the atmosphere is not. There's a seller on the other side. You'll hear about people who are shorts, basically people who short the market. Those are people are also known as sellers. All right. Not buying calls or puts. This is the exact opposite of that. The exact opposite. So if you got your brain set on buying calls and buying puts, I need you to kind of flip your brain to the opposite of that, because I'm going to talk about opposite things. With buying, you pay to play. With selling, you get paid to trade. That's the main difference between those two. But there's a lot of other differences are there too, but When you're selling, you're going to enter the trade as a seller, and you're going to get paid to enter the trade. All right. Anytime you're creating or starting a new contract, you are opening. So you're going to sell to open. You sell to open, STO, right? And when you're closing it, you're ending a contract, you're going to buy to close. Basically, you're doing the opposite of what you did to open. When you're working with buying strategies, you did a buy to open and a sell to close. Flip that around. When you're selling, you're doing a sell to open and you're doing a buy to close. Sell to open, you're going to collect a premium. Buy to close, you're going to buy it back, hopefully at a lower price, and you're going to keep the difference between those two. When you're a seller, you collect money or premiums to enter the trade. Basically, you get paid to trade when you are a seller. You get paid to trade. As a buyer, you have to pay to play. And if you know about buying, how many of us here have been buyers? Put me a 1 in the chat if you're somebody who's bought options in the past or you're currently buying options. Either one, put me a 1 in the chat. If you're a buyer, you've bought before. Many people started learning as a buyer, right? Most people started learning as a buyer. I see a lot of ones. I actually started learning as a seller. When I first started learning to trade options 3 or 4 years ago, I went looking. Nope, that's not what I wanted to do. I actually wanted to cancel. There we go. Stop share. That's what I wanted to do. I actually went to into the market. I was looking for a way to learn how to trade options. And where am I doing? I'm trying to make sure. There we go. This shouldn't be pinned. There we go. I was looking to learn how to trade options. And the first people I ran into were people who were selling. I'm not sure if anybody has come to me by way of Randy Yancey, but that's who I made my unofficial mentor. I made him my mentor because he was posting in the groups that I was in and I had more questions. So I started to ask him a bunch of questions and he always answered the questions. So because he always answered the questions, I continued to ask him. So he became my unofficial mentor. He didn't know he was my mentor, but he was. And I learned options as a seller, right? I went from there and I said, okay, well, I felt like even though I knew what I was doing with selling, I felt like there was stuff that I didn't know. And sometimes when there's stuff you don't know, like what you don't know will hurt you. And I didn't want that. So I went looking to learn more. People would always say, do your due diligence. And I never knew what that was. So I went into got a program and learned all the other things about trading stocks in general. I learned about candles and candlesticks and charts, and none of that stuff I knew when I first started. I learned about all those things. And I also learned how to buy options then. And I switched over a little bit as a buyer. I saw there was a lot of possibility in buying. I did it. I won some money. I lost some money. And I was like, let me take my little booty right on back over to selling options because that seemed to be my lane. So I went back to selling options, started working with credit spreads. Some of you may know me by way of the strategy that we came up with. It was a really good 1 DTE strategy a couple years back before the volatility went crazy in 2022, 2023. And we continued to work with it, but we had to change up that strategy because it wasn't as good for the 1 DTE, or we didn't know how to manage it real well for 1 DTE. So I continued to learn, continue to learn so that way we could get better. We could all get better, right? We could all get better. All right, Mr. Earl looks like he is here. I'll let him in. There we go. So that's really my story. That's how I came to be and continued to developed or opened Educator to Trader, started Educator to Trader, and have taught people all along the way for the last lots and lots of years. Seems like it's been a long time. But a lot of people have come through the doors of the Educator to Trader. But we're here now, and this is where we are. Anyway, let's go back to where we were. There we go. So when you're a seller, you're going to collect money. You're collecting premiums to enter the trade. You get paid to trade when you're a seller. Get paid to trade. As a seller, you want to be out of the money at expiration. You want to be out of the money at expiration. When you sell a call, you want the price of the underlying to end below your strike price. When you sell a call, you want the price of the underlying to end below your strike price. right? Which is different. When you're buying calls, you're expecting price to go up, right? But when you're selling a call, you're expecting price to stay below your strikes. It's a complete opposite. I keep saying that because I know I just saw a lot of people who say they're buyers, and I want to make sure that your brain doesn't get confused when I'm using some of the same terminology, but I'm using it differently. When you're selling a call, almost like a covered call, if anybody knows about covered calls, you're expecting the price to end below your strike price. And when you sell a put, you want the price bullish move. Selling a put is bullish, selling a call is bearish. The benefits of credit spreads. It's a pretty straightforward. I like to use the word simple strategy. I think it's simple compared to a lot of other strategies because there's other strategies that require a whole bunch more, and this one just doesn't. So I think it's a simple strategy. It can be done on any equity that has options. You can do credit spreads on any one of them, and you can generate consistent profits without a lot of collateral. Okay, without a lot of collateral. Credit spreads are often called vertical spreads. You may see them you may see them as bear spreads or vertical bear spreads, vertical bear credit spreads. I mean, there's a few different things, but you want to know that put credit spreads are bullish with the thought that the price will go up. Call credit spreads are bearish with the thought that the price will go down. Put credit spreads thinking price is going to go up. Call credit spreads with the thought that the price is going to go down. Stay where we are or go down. Basically, credit spreads are a two-legged trade. They consist of buying a contract and selling a contract at the same time. That's why it's called a spread. You have a buy contract and a sell contract at the same time. It's called a spread. All right. Let me move this so I can keep going. Call credit spreads, also called bear call spreads, expecting the price to be below your sell leg strike at expiration. Put credit spread, also called a bull put spread, expecting price to be above your sell strike at expiration. And the reason I'm saying these things a couple of times is because I want to make sure that, because this is the place where people get confused, and I want to make sure that you don't. Because as I keep going, I'll be saying call credit spread, put credit spread, and I want you to have in your brain that call credit spreads are bearish and put credit spreads are bullish. So the exact opposite of buying, because usually when you buy a call, you're expecting price to go up, and when you buy a put, you're expecting price to go down. This is the opposite of that. It's the opposite of buying. Here's a graphic that may help a little bit. Put credit spread. Selling a put credit spread is a bullish strategy where you expect price to be above your sell strike at expiration. When you enter a put credit spread, the price can stay flat, it can really do nothing, or it can go up. You want it to be above, it can even go down a little bit. It's a little confusing. Yeah, it's a little confused. I think as we keep going, Stacey, hopefully it'll get clearer. And if it doesn't, keep asking to make sure that I make it clear for you. The price can go down a little bit. You just don't want it to go down to your sell strike. You don't want it to be below or at or below your sell strike. That's for put credit spreads. Put credit spread is a bullish strategy where you expect price to be above your sell strike at expiration. When you're doing put credit spreads, you're selling a put contract and you're buying a put contract at the same time. You're selling a put contract and buying a put contract at the same time with the thought that the price will stay or will at least expire above your support, above your sell leg. That's what you're expecting here. Our put credit spread steps. Basically, we're going to chart the support on the daily time frame. Select a sell strike that is below the support. We're going to go through these steps. I'm sharing them with you, but we're going to actually do them. And then select a buy strike below the sell strike. So you have current price or support, sell strike underneath that, buy strike underneath that. Okay, so with current price, down on a put credit spread. You're going to decide your expiration. Remember that theta decay is our friend. He's our friend. It's amigo. Theta decay, you can enter credit spreads literally the same day, the previous day, the week before. Theta decay helps your trade to be successful. Time decay helps your trade. We know that as a buyer, you don't want the theta decay to catch you because it'll be eating up your premiums and you need the price to keep moving. But when you're a seller, you're okay if time is passing and the stock isn't doing anything. If you're a buyer, you're not. You're like, it needs to be moving. If you're a seller, you're like, it's fine if it doesn't move. Fine with me. Long as it's not at my strike, it can take all the time it wants. Take all the time you want. Okay, so call credit spreads. Selling a call credit spread is a bearish strategy where you expect price to be above. No, you expect price to be below your sell strike. I'm confusing myself. You're expecting price to be below your sell strike at expiration. This needs to be below. We're expecting price to be below our sell strike at expiration. Okay, it's a bearish strategy, expecting price to expire below our sell strike at expiration. You're selling a call contract and buying a call contract at the same time. Same time. And what are the steps here? You want to chart resistance in this case because this is a bearish move. So you want to get above the resistance, sell a strike above the resistance and buy a strike above that. Current price up for the sell strike, up for the buy strike. Current price up for the sell strike, up for the buy strike. Decide on an expiration. Remember theta decay. We like theta decay. All righty. Do we have any questions so far? Explain strike price. We're going to get to that, Abra. We'll make sure that we get there. Any questions so far? Starting with the chart is the key to profitable credit spreads. You need to know where's the support and resistance. Basically, what we're looking for is where will price not go. We're looking for where price will not expire. So we want to go beyond resistance, beyond support, so that way we can see where price will most likely not. Of course, price can go where it wants to. We've seen it happen, especially this week, where price goes where it wants to. But you're looking to find where price most likely will not go. Okay, support and resistance. Where the price goes and reverses, we're looking for the peaks, the valleys, and the rest areas, especially for the time frames you're looking at. Where will price not be for our expiration? And you're also keeping in mind the trend, because if there's an upward trend, that can help you with your support and resistance too, because the bottom of an upward trend is going to be support, the top of it could be resistance, and if it was a downward trend, the opposite. Right? Your whole point is that you're trying to find out where you think price will not go by expiration. Where will price not go by expiration? Okay. So I pulled this bar chart. I actually pulled this yesterday. Wanted to be fresh. Looking for support and resistance. Looking for support. And if we were going to think about entering this SPY trade, and this was what we had to look at to enter. You want to look for your support. You want to look for resistance, do your good charting. Now, I'm not sure how knowledgeable we are about charting. If you're somebody, if you know about charting, support and resistance, put me a 1 in the chat. If you know how to chart support and resistance, put me a 1 in the chat. If you don't have a clue about charting, give me a 2. If you don't have a clue, like I don't know nothing about charting, give me a 2. I'm looking at the chat so I can see what kind of answers. That's why I'm looking to the left. Okay, looks like we've got some thoughts. We do know, if you don't know how to chart, you need to put me a 2 here, because otherwise I'm gonna talk about it like everybody knows what I'm talking about. Oh, there we go. Thank you. Thank you. Support and rallies. We're looking for the peaks and the valleys. Okay, I struggle with that. I appreciate that. We're looking for the peaks and the valleys. If we're looking at this chart, the peaks and the valleys, where does price go and turn around? This would be a valley, right? This would be a peak. It's kind of far away from where we currently are, and there's other peaks between current price. The last candle is the current price, and the peak that's between here and there would be this. This would be a peak. Looking for places where price goes. It went down here, went back up, went down, and it's gone back up. That's what's going on here. This is also a valley. It's going to look like a peak when we put this on our chart, but it's what you're looking for, peaks and valleys. I'm putting a P here, I'm putting a P here. These are our peaks, and the V's are our valleys. That's what we're looking for. And we've looked back here, we can see there's some stuff that happened right around in this area. It kind of like didn't go past all of this. This would fall in one of those peak areas. One of those valley areas where it just kind of went down here and hung out, and then it started moving. Okay. Anytime you see it stopping like this and kind of lingering in an area, this would be support or resistance. And know that support and resistance can change. It can be support in one place and be resistance the next time, right? Right now, it looks like back here, it was support. It was support. None of these could go below it. Price went up, came back down. When it went through it right here, though, it broke through that support, went down, and now that same area from here is now looking like it's a place to slow down. It's like a resistance. So they can flip-flop. The whole point is you want to see where are the places where the price changes, where it can't go past it up or can't go past it down. We also have some gaps here for those who know about charting gaps. There's a gap here, and gaps do provide support and resistance as well. If they're above current price, they will provide some resistance. If they're below, they will provide some support. Okay, let's look support and resistance. I think I got the next chart puts the lines on it. There we go. So I put here an area or 2 areas. There's an area for support. Okay, this was a gap back here. Don't know what this date was, maybe June 10th, because this was July, this is June. This is a daily chart. If you're looking up here, I'm on the 1-day chart. Let me get my annotation back. I'm on the daily chart. Now, this is TradingView we're looking at here, but you can do this same thing on your broker, depending on what broker you're using. You can do charting at your broker. If you're using Robinhood, their charting is not all that fantastic. So you might want to consider doing TradingView. Or if you have another broker, then maybe to use that one for your charting. All right. But I wanted to show here that this is the support area. If this is the current price, putting a C next to it, let you know this is current price, right? This was the last day, and you're looking from there going back. So our support between 535 and 538. And the reason I made it this wide is because of the gap back here. That matters because if price comes down into it, it could get into it and go down. Support will be at the bottom and the top of this gap. Wanted to put that there. Resistance. This is another gap that's up here back from, what's this, July 22nd, July 23rd in here, right? There's a gap here. There's also another, resistance line above here that shows where it actually did do the turnaround and then it skipped over it That's what created the gap. Support and resistance are in these two areas. Now, if charting is something that you still need to learn more about, or you really want to get better, we got a resource for that. All right, we got a resource for that. Our class today is not really about charting. It is about credit spreads. You can go to chartyourway to100k.com. There's two things you can do. You can do chartyourway to100k.com. That's really going to give you that free. That's going to give you that free charting cheat sheet. And then you got start with the chart.com, where there's a free webinar that you can start with the chart. Okay, I put those two things in the comments. All right. I also have a chart your way to 100k training on my website. If that's something you really want, it includes all the stuff. It includes all the basics, starting from what is a candle, all the way up to using indicators and using different things. I mean, it's all the pieces. It talks about candlesticks, candlestick patterns. I mean, it's a full Monty. Okay, that's the full Monty. And that is over at my website, educatortotrader.com. All right. So support and resistance are here on this chart. You want to chart support and resistance so you'll know where price won't go. You're thinking of where will price not go. You want something out of the money. You want your strikes to be out of the money if possible, right? Did we have any questions on that before I move forward? Do we have any questions here before I move forward? I need to move my chat where I can see it easier. No, we're good. Okay. Make sure I can see the chat. We're going to pick strikes. And we can pick strikes using support and resistance information that we just, accumulated, as well as probability out of the money, delta, and the IV, or the plus minus number, I call it. I call it the plus minus number. It really does have a name. I think it's called implied volatility. Okay. Picking strikes. Probability out of the money, delta, IV, plus minus number. I'm going to show you what I'm talking about. Now, this is in Schwab. This is in Schwab. What, tell me in the chat which brokers that you all are using. Tell me in the chat what broker that you're using, because some of these things are not on some of the brokers, but every one of at least one of these things is on all the brokers. Okay, Di says he's on Schwab. I think it's a she or he. Di said, no, it's a he. TradeStation, Miss Scott, you should. Janae, is probability out of the money on TradeStation? Schwab and TradeStation. I don't think I remember. We talked about it. We'll get Schwab. Yeah, I'm okay there. Janae or somebody else who does TradeStation, is probability out of the money there? Stacey says she uses Fidelity and TradingView.
It is. Yes, we do have an indicator for probability out of the money. I think you can change it to ITM or OTM too.
Yeah, you can do that same thing on Schwab. Probability OTM. All right, thank you, dear. So probability out of the money, you see it. I have it on my option chain. And if you don't have it there, you can go under here where it says layout. I actually will, when I go into Thinkorswim, I will show you. This is actually Thinkorswim. It's not Schwab. It's Thinkorswim, because I don't trade directly on Schwab. I trade on Thinkorswim, which was TD Ameritrade, and I kept Thinkorswim all the way through because I know how to work with that. Right. So this is Thinkorswim. Let me call it what it is. If you when I go into my Thinkorswim, I will show you exactly what to do. But basically right here in this area where this drop down is, right there, you can go and select the things you want to put onto your option chain and things you want to take off. Because initially, I think the default includes stuff I don't necessarily need. I didn't need, so I took them off. But some people have more things here. And for me, I just can't have a lot of stuff because it's too distracting. But probability out of the money, delta, volume. Sometimes I have open interest and bid and ask. That's bid and ask you can't get rid of either way. Volume, probability out of the money, delta, and open interest are the ones I have on my chart. Are the ones I have on my option chain. And you can put them, you can drop this box down and pick customize and then pick the things you want to put on and pick the things you want to take off. Okay. This is where these are. Probability out of the money and the plus minus or the IV number. I call it the plus minus number. Again, it's called the implied volatility number. And I'll talk about what these are here on the next couple of slides. But these are the things that I have on my option chain that help me to decide which strikes to pick. Help us to decide which strikes to pick. Okay. I'll show you again when we get to the option chain, so that way you can put these on your own chart if you want. Probability OTM, prob OTM is the probability of being out of the money. And as a seller, you want to be out of the money. We want to be out of the money as sellers. Right? This is where we want to be. When you're a buyer, you want to be in the money. You want to be in the money. But when you're a seller, you do not. In the money as a seller means that your credit spread or your sell leg has been breached. That's not what you want. We don't want price at our strikes as a seller. When you're a buyer, you do want, you're like, yes, I want you to go on past my strike. Yes, get me in the money. That way I'm making money. But when you're a seller, no, no, no. Because when you're in the money as a seller, you're not making any money. You are actually losing money. And this is not what we want. Basically, we want to look for a strike with 75% or more probability out of the money. 75% or more prob OTM. That's what we're looking for. Delta is the probability of the price reaching this strike. I'm not sure why these lines have just popped up all rando inside of my stuff. Like, where do these lines come from? How did you get here? 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 The OCD in me won't let me leave it. And of course, my computer is slowing down because you're doing the most. Where was I? I'm over here somewhere. Oh, please. I figure out why this is tripping. Okay, come on. You can do it. There we go. Whew. Y'all help. Delta is the probability of the price reaching the strike. Delta has a lot of different things that it is. Delta is the amount of money you're going to make with every dollar move, make or lose with every dollar move of the underlying equity. That's one thing Delta is. Delta is also, though, the probability of a price reaching that strike. It's the probability of the price reaching this strike. Okay, of course, we don't want our trades to reach that strike. So we want a low enough delta, but not so low that we don't make any money. Because if you get too low on your delta, there's no premiums for your trade. And that's not what we're after. We're not after being so safe that we don't make any money, because we're totally here to make money. We're not here just to be saying, I'm a trader. We're here to make money as a trader. Yes. We want to look for a strike with less than 0.25 delta. So we're looking for a strike with higher than 75% probability out of the money and with less than 0.25 delta. Y'all see the correlation there? 75% probability out of the money is the same as 0.25 delta. They are the balance of each other. And if you're trading like with Robinhood, or you're trading with somebody who doesn't have probability out of the money, then you can still use delta at the strikes you're looking at to determine what would be a good strike. You can still use delta to determine what would be a good strike. All right. IV, or that plus minus number I was just talking about. It's the broker's expected move by expiration. It's the broker's expected move by expiration. Basically, we want to add and subtract it from the current price to help us select strikes. So there's 4 ways I've just talked about, and we kind of use them all together to help us select strikes. You can look at support and resistance. You can look at your probability out of the money over 75%. You can look at delta below 0.25, and you can look at the plus minus number. Okay, just so y'all know, I am recording all of this, right? I'm recording all this, so you can take notes, of course, but any of the things you need to see, again, we don't have any problem showing you, and you will have the video, right? There we go, there we go. Back to probability out of the money. And the same SPY we were looking at a second ago. I talked about look for probability out of the money of greater than 75% and less than 0.25. Greater than 75% on probability out of the money and less than 0.25. Again, notice these two balance each other out. 0.21 is the same thing as 21%. All right, down here looking at the call side of it, 77% probability out of the money is the same thing as 23% or 0.23 delta. Same thing as 0.23 delta. Our plus minus number up here, these were the strikes that I ended up with, 540 and for 548, right? Plus minus number, plus minus 4. Means you take this current price of 54,544, right? Take your current price of 544. We're going to add 4 to that. We're going up for the call side. We're going to add 4, which puts us at around 548. Right? And if we subtract 4, that puts us right around 540. So have these things line up to help you pick strikes. Sometimes this plus minus number won't be as clean of a lineup with these deltas. And then you have to decide, like we trade Enphase is a stock that sometimes we trade. Enphase has a big plus minus number, but generally it doesn't match up with the strikes and the probability of the money in the delta. So because we've watched Enphase enough and we know how it goes, we will lean more on the plus minus number because Enphase can be known for wild swings. So we want to, this really takes you knowing the stock, or trading in your sim, paper trading and practicing, right? To make sure that you see which one of these things works the best for you, whether it's probability of the money in delta, plus minus number, support and resistance. You're going to see which thing you like the best, or all the things. Because personally, when we enter credit spreads, we look at all of them and then make a decision on which strike. We look at the probability, the delta, that plus minus number, the support and resistance on the chart, and then we make a determination from there. Do we have questions here? Pausing for the cause. Questions here?
Quick, Alyssa, when you was going over the delta, it serves 2 purposes, right?
Yes.
Want the higher it moves with the dollar, but then it
Yes.
also serves as
The probability,
as you said, the probability of
success, of reaching that strike.
Higher and higher. Okay. And 2, I guess, okay, so okay. I just wanted to confirm, but I think I got it.
Okay.
It's better
Cool.
that it's higher for both cases.
You want the delta to be as low as possible, and you want probability of the money to be high as you're comfortable.
Okay.
Okay.
So I guess it just depends. So, but for the most part, we're using it for probability out of the money, not so much the dollar movement for the premium.
Right. You're not using it for that.
Okay.
Yeah, because we know as sellers, and selling a spread, we're not looking at that at this point. No, we don't. If you were buying, you would care
Oh,
about, you might be
okay.
more concerned about that. But as a seller, you're not.
That's the difference. Okay.
Yep. Okay.
Yeah, you got to remember to switch with these two, depending on if
Yes.
you're buying or selling. Got it.
Yes. Yes. You do want the delta to be low, Maria. You want the delta to be as low as possible. Not just because you're selling, but that lower is a possibility of is a lower possibility of the stock reaching this price. So this 21 delta, this one delta basically is a 21% chance the price is going to get to 540. But like this 12 means this is a 12% chance it's going to reach 538. And it's a 7% chance it's going to reach 536 because you're further and further away from current price. The only thing is, if you're picking spreads, when you'll see when we go to the option chain, if you pick spreads that are further away in the 5 and the 10% area, 10% chance of something reaching is a 90% chance of your success. If you got the higher your possibility of success, the lower money you're going to make. That's how that goes. So you got to balance out what's a comfortable place for me for my strike, as well as a comfortable place for me to take in premiums, because again, we're trading for money. And if you want to make sure that you're taking in enough premium that will satisfy your desire for your profits. Because you can go down here, and end up taking in $3 or $4 per trade, but no, you might not be interested in taking in $3 for a credit spread while you leverage the other 97, right? We'll talk the money here in a minute about what the money of credit spreads means. What does that look like? Okay, Wesley, I think I answered your question, but Wesley asked, why should we look at the IV? And I said, because this is the broker is saying this is their expected move between plus and -4. So I keep that in mind, because if the broker, who can see stuff we can't see, believes that it's going to move somewhere between plus or -4, and I want to be where the price is not going, then I will go a little bit more than what the broker is saying. Or it's probably going to move +4 or -4. I'm like, well, I want to be beyond that. So that way I'm where price does not come. We want to be, as sellers, we want to be where price is not going, or at least not expiring. Let's talk about the money, some money of the trade.
Out of the money.
The money, the money, money, the money, money, money. Oh, I didn't even know I picked the girl with the dollar signs to go here. Look at you, Arlissa. You so fantastic. Okay, the difference between the two strikes is called the spread. Difference between the two strikes is called the spread. A one spread is worth $100 of collateral. What would be a one spread? A one spread would be 25, 26. And I'm writing with my mouse, so pardon if it looks, janky. 25, 26 will be a one spread. That's because the difference between these two is 1. 26 minus 25 is 1. Times the 100 contracts, the 100 shares. When you're doing options contracts is 100 shares per contract. So a one spread is the 1. The difference between these two is 1 times the 100 shares, means there's $100 of collateral for a one spread. A 50-cent spread, maybe you got 25.5 and 26. The difference between these two is 0.5. 26 minus 25.5 is 0.5. That's a 0.5 spread multiplied times 100. That's going to give you $50 of collateral. 0.5 times 100. $50 of collateral. 2.5 spread, maybe you got 150 and 152.5 is your spread. That's a 2.5 spread because the difference between these two is 2.5. times 100 is $250 of collateral. SPX is 5 spreads. SPY is a 1 spread, right? A lot of the airlines and some of the smaller, some of the bigger things, like I think TQQQ used to be a 0.5 spread. It might be bigger now because the price has gone up. But 50, you can find something from all these categories, all right, easily enough. And the premiums you collect are going to be in line with these, this width or this spread. Okay. Now, when we talk about collateral, when you're entering a selling trade, you're entering the selling trade and you're collecting premiums. You're collecting a premium, but the broker is going to block off the rest of the collateral for that trade. So if you have a 1 spread, we're going to talk more about this. If you have a 1 spread, right, and you go in and you collect $10, the broker's going to give you the $10. $10 is for you, right? And the other $90 is going to be collateral. Basically, the rest of that spread is collateral. The broker is going to block away that buying power. It's not going to take the money, but it's going to keep it from you being able to use it for other things. Okay, it's not, they're not taking it. You haven't paid for anything, but the broker is going to block it off while that trade is going, because it's basically your coverage or your insurance or your collateral for this trade. It's almost like when you go to rent a car, right? They give you the car and they block up a couple $100 of your money on your credit card until you bring their car back. Same thing is happening with this selling trade. Same thing is going on there.
It's insurance.
It's insurance. Yes, it's insurance that if this trade goes wrong, we already got the money to cover it. Right? If it goes wrong, you got the insurance to cover the trade. All right, let's talk about put credit spread. We just talked about these numbers. When selecting your put credit spread strikes, the sell strike must be closest to the current price. The sell strike is closest. If I want anybody getting them mixed up, and I'll show you the difference here when we get to the option chain. Current price 544.44. The put strikes are below the current price. We want to be below current price. And we decided, based on a couple charts ago, we saw that, what did we say, 540 on the put side. Put credit spread would be here. We said 540 as our sell strike. This is the one that gives us the probability of the money we want. This is the sell strike of 540. And then we go down one more, or in this case, looks like you're going up, but you're really going down in price to the 539. Looks like it's up just because that's where the option chain is set up, but you are going down. 540 is our sell strike. You'll see on the option chain when you're in the trade, it says -1. And below that is the buy strike of 539. Now you can widen this, you can make it, you can go 538, 537, you can make it a wider spread, and sometimes people do. The one that's the most important is that sell strike. The most important one is this one. Give me my pen so I can, write. Here we go. The one that's most important is this sell strike, because it is the one you don't want the price to enter or to expire below. You don't want the price to expire below 540. This is the one that is of most importance. That's why we take the time on the option chain to identify the sell leg with the probability of the money and the delta, because this is the one that matters most.
So if we were
Go ahead, Janae.
if we were on the options chain, because this is the one that gets me, especially if I was to consider a defense strategy.
Are you still talking?
Yeah, can you hear me? Yes, no?
Mm-hmm.
Oh, I was saying.
Now I can.
Oh, okay. So if we was on an options chain and on the put side, it would be 539/540. Is that how I would read it?
Yes.
If it was on the
Yes.
the right
The
side.
vertical. Yep. I'm getting ready to go to that screen.
Okay.
Yes, it would
So
be.
that's the thing that when it's done in the options chain, I get it, but I do
Mm-hmm.
need to be able to, when people like you or somebody says, make sure your sales strike or your insurance leg is always good, covered. I literally have to pause and say, wait up, what side is that?
Yeah.
So I want to
Yeah.
get better with that.
Yeah. I'll show you. I'll definitely show you that. That's a good question. Okay, so this spread is a one spread here because 539 to 540 is only one, right? It's going to use $100 of collateral, and I'm going to show you that in this case you would collect $14. It's going to show you on the option chain, which means if you're collecting $14 in premium, then you're going to put up collateral of the remainder of the 100, which is $86. That collateral is also your max loss. That's the most you can lose on the trade is the remainder of that $100. That's your collateral and your max loss, which is one of the other reasons why I like credit spreads. You know exactly what you're going to make on the front side. There's defined profits or premiums, and there's defined losses. Defined premium, defined losses. Here we are. This was the question Janae was just asking. We are on the option chain. I have changed it to vertical. Before we were on the single chart. I've changed it to vertical. Okay, and we've got 539, 540, and we're looking on the puts side because we're doing a put credit spread. You want the insurance leg or the sale leg that we found, you want that to be closest to the put side. Notice there's a 539, 540. You could be over here with those same numbers, but this is not where we want to be. No, no, no. We're doing a put credit spread. We're below current price, so we're doing a put credit spread. We want to be over here to the right where the puts are. Okay. And we're in the bid column. As a seller, you're in the bid column. Sellers are bidders or writers. This is what we want. If you're a buyer of options, I know you've been in the ask column. If you're buying, you've been asking. Nope, nope, nope. We're bidding. We're bidding 539, 540. It says here $14 is in premiums. Once we push the button, it actually gets bigger. But this is what the option chain shows. 539, 540 is the trade. It's the one spread, $14 in premium, $86 of collateral. The broker is going to block away of your buying power. That is your max loss. That is your max loss. Question.
So it's max loss of 86. So if you got a one spread, then it's 100. So at the current time, it's $86 that is put off to collateral. If you get breached, because there's a tidal wave, it just goes the other, it breaches, it's the 86, it's the 4 and the 14.
Well, they gave you the 14 already, so they've basically given you $14. So when you enter this trade, they give you $14. And when if you're completely breached, you
Right.
lose 100, which equals a loss of $86. Like they gave you $14 and took them back, but your own money is only $86.
And the 14, correct? Because I know.
They gave you the 14.
So
So your money
that
is the
part
86.
was priorly, but then the after part, is it not the full 14?
They're going to take the full 100.
Okay.
So, but part of that 100 was money that they gave you. So they're going to take their money back and some of yours and keep yours. They're not going to take it. They're going to keep it.
Right, that part.
Okay. No, it's $86. When I say, because this was 0.14, so 0.14 is $14. right? And subtract $14 from 100 means you're going to, $86 is the other part of that for collateral. All right, let's go look at the call side. I'm slowing down here because this is where it gets can get convoluted. Okay. Nope, this is not what I want that to say. That's not what I want that to say. Oh, please. Above currently price. Who in the world? What's a currently price? Y'all seeing these errors on my slides and not saying nothing? Let me find the girl. Where are we? Oh, there we are. I type fast, and sometimes when you type fast, you put stuff in here that don't belong. There we go. I think I got it right now. I think I got it right now. We can go back here and we can go back to sharing. Hey, Sylvia. Some of y'all came in. Hey, Earl, you came on in too. Hey, Jackie. Some more people showed up. I want to make sure to say hi. Hi, Lisa.
Good morning.
Good morning.
Hey there.
Hey there. All righty. Call credit spreads. When you're selecting your call credit spread strikes, the sales strike must be closest to the current price. It's going to be above, but you want the sale leg closest to the current price. Call strikes are above the current price. Call strikes are above the current price. Sell a call strike, 548, and buy a call strike is 549. Notice we're at the current price is at 544, so we're going up to 548 and then up again to 549. All right, then up again to 549. This is an 8. I want to make sure that looks like an 8. Up and up. 548 is the sell leg. 549 is the buy leg. Again, this is one spread because the difference between these two is one spread. You're going to collect $22 in collateral. That is bad math. You're going to collect $22 in collateral, which is not $86 of loss. It is $78 of loss. Where are we? Go back one. I think it's here. Got to have the spread, the strike, the little thing has got to be correct. Because I use these slides later to make sure that I send them to people who need to see them, and the information needs to be correctamundo. Is that a good Spanish word? Correctamundo? I don't know if that's right. Jamie, is that a right word? Jamie's our local Spanish resident Spanish guy. You collect $22 in premium.
Gracias, thank you.
Oh, Miss Marcia's outside. Let's get in. I know how long she's been out there. Hi, Marcia. Sorry. Yes, gracias. Gracias. Where's my chat now? There we go. Make sure I keep it there. Yeah. Wesley, you are. You can see bad spelling. Okay, so the call strikes are above your current price. Sale strike is 548, buy strike is 549. It's a one spread. You're collecting $22 in premiums, which is a collateral of $78. If you were only doing the call credit spread, this would be how the numbers would look with that. If you were only doing a call credit spread. Okay, this trade, we're on the call side now. We're on vertical, we're on the call side, 548, 549. Right here on the call side, right? We want 548, 549. We don't want to look on the put side, which is over here to the right, because we're doing a call credit spread above current price. We're going to collect, it says $20 here. Once we select it, I'll show you on the option chain that it makes it $22, but I want you to see that this is the 20 that shows up here. $20 shows up here. Once you click it, it does change. $20 premium, what does that tell us? What's our collateral if it's $20 premium?
80.
$20 premium is $80 collateral or max loss, $80, yes. 80 in collateral and max loss. The broker is going to block away $80 of your buying power per contract. Going to block away $80 of your buying power while this trade is on. That's the insurance we were talking about. This is like the deposit that you're paying to be in this trade. The broker's going to block that money away until the trade is closed, and then it will release. Whatever it's supposed to release to you, it will release it. The broker will release it. All righty, let's go do some. At least I want to look at this particular trade. I want to show you the same numbers we just did. I'm also going to show another one. Let me turn off. I'm going to turn off on demand. Come on, baby. Let's change the screen. Okay, we're looking at that SPY. Make it bigger so everybody can see what's happening here. Very large. Okay, we're here. We looked at some strikes. This is these are pictures of the same screens that you just were seeing. It's just now I'm in the option chain where I'm actually here now, right? I'm on the single screen. Remember, this is Thinkorswim I'm looking at. Jamie says the resident Spanish guy is a gross mischaracterization. Well, keep leaning on Duolingo. You can keep leaning. We got the probability out of the money is here. Our delta is here. Our plus minus number is here. Probability out of the money on the call side and on the delta on the call side. We've got both of those things here. Remember, as sellers, we're not looking at the bid column yet because that needs to be on vertical. On single, we're looking here. Probability out of the money. We talked about this one here. The probability out of the money is 79, which gave us 540 as our sale leg. Probability out of the money of 77 and 23 for the delta, which gave us the sale strike of 548 for the call credit spread side. Looking at all the same, it's the same stuff I just was showing you on graphics, right? I'm going from here now. Oh, while I'm here, let me go ahead and show right here with where it says layout. Not sure if y'all can see my mouse moving around here where it says layout. This is where you drop down and add things that, or add and subtract. I did a customized, you don't need Gamma, Data, Vega. You don't need all those guys on your option chain. You don't need all those. Definitely not for this. You don't need it. Maybe some other strategy you need those things, but not for this. Probability out of the money. If you're over here in the available items, you can start typing in prob, P-R-O-B, and there's a probability in the money, probability out of the money. And there's a probability of touching. I don't worry about the touching, but I do think it could be useful depending on whether you're trying to see if there's a probability of something touching a strike, but for a different strategy. It could be for this one too. Maybe it'll touch our strategy and then go back. That touch our strike and go back. You could go with that too. I want to make sure that I am recording. It needs to not be not recording. Okay, cool. It's still going. Oh, don't be, that makes you so nervous. I would hate to be partway through and be like, I wasn't even recording. Nope, it's going good. Okay, so probability out of the money, in the money. And when you pick what you like, you can say add items and it moves it over here. If there's stuff that's over in the current set that you don't want, like if I didn't want volume, I could highlight volume and I could say remove item and it would take it off of there. So anything else you got in here that you don't need, like change, and someone's one is change. What's about a lot of that stuff I don't, you see, I don't use all that. Probability out of the money, delta, volume, and I will have open interest, but most of the stuff, all the other stuff that they give you, I don't put any of that on mine. That's right here under layout. You drop down the box, pick customize, that way you can pick and choose what you want. All right. So we need to go though to, now that we got our strikes, like 540 and 548, we need to change from the spread. Let's change this. Nope, that's not what I wanted. We need to change from spread single to spread vertical. We now need to go with vertical. Go to vertical. And then we did 539, 540. We liked. This is the 14. 539, 540. We like that. Okay, I'm going to click the bid column, not ask. If you're a seller, you're a bidder. I'm going to click bid. When I do that, it brings up this screen, the order screen. I told you it was going to change that to something else. In this case, it's $16 instead of the 14 we talked about, but it's red. It's red, letting you know that you are selling. There's going to be a credit that you're going to receive. You're going to receive a credit, which means you are going to get $16. It's red as a seller. It says here that you're selling one contract of SPY at the 540 strike, and it's a put. And you're buying one contract of SPY at the 539, and it's also a put. This spread is a one spread. You're going to collect $16 in premiums, PREM, $16 in premium. What's our max loss then? What's our collateral and our max loss? If we collect 16, we could lose 84. Our broker is blocking away $84 while this trade is going. The broker is blocking away $84, right? As sellers, we want to sell as high as possible and buy back lower. You want to sell high, buy low when you're a seller. Sell high, buy low, right? That's what's going on with this trade. 539, 540, it's red. It should be red. You should be expecting to take in a credit of $16. Questions? Let me clear this off so I can go to the call credit spread side so I can show you what's going on over there, because we looked at that trade too. Okay.
Hi, Arlisha. It's Maria. I
Go
have a
ahead.
quick question. So when we go back to the spread, and that was the $100, is that only, should we only think about that in terms of SPS, meaning does that collateral number change if we're shorting another pair, you know?
It's going to depend on what premiums you take in. So whatever stock you're doing, whatever premiums you take in, that's what's going to be determined by. And the width of the spread. If the width of the spread is a 1, if between 539 and 540 is 1, if it's a 1 spread, then you're going to take in money, and the difference between that and the width of the spread is the collateral and the max loss.
Gotcha. Not dependent on. Okay. Okay.
Right.
Gotcha. Thank you.
Yeah, it's going to be stock dependent and strike dependent and basically trade dependent, whichever one you're picking.
Okay.
Right. So I'm going to show you here. So like if you were deciding, you're like, well, I feel a little more risky. I think I'll go with, 540, 541. Maybe you say I'm feeling a little more spicy today, and I think I can go up one more strike. Well, back here we got $16. We can click the next one up and it takes in $20. It's still a one spread. So now you would receive $20 and put up $80 of collateral. right? So it's really going to come down to your comfort level with which strike. 542 is, 2 points below current price. Are you more comfortable with that? Could be, depending on your situation. That strike takes in $25, which means you're going to leverage $75. Okay, so we want to make sure that we're getting as close or far away. If you went back, you say, okay, 540 feels a little too close. Let me go one more out the money. I'm going to go to 538, 549. That one only takes in $12. So you're putting more up for collateral, but you're receiving less in premiums. It comes down to, it's kind of a dance, which is why we do, that's why we look at probability of the money, delta, and the plus minus number and the chart to see where do we feel is a comfortable place. Where am I comfortable? Sometimes I'm comfortable, usually around 70% probability out of the money. So I would probably go with 541. There's other people who are right here on this call who are like, they need to be in the 80s. So they're not going to be at 541. They're going to be at 530, 539. It's a personal preference, right? I just say make sure that for comfortability, at least 75% probability out of the money, which is a 25% chance of profit, chance of your trade being successful. I think 75%, chance of profit is pretty high. Some people want more, and some stock you need to change, like SPX. SPX don't like 75. It just, you got to get a little higher with SPX. We're like 80, 85, because SPX can be wild. So it can be stock dependent as to which probability of the money you're comfortable with. I hope I answered your question. Did I, Maria?
Yes, you did. I just want to make sure if I'm looking at SPS and I'm looking at Adobe, I'm doing the same thing.
Yes, you're doing the same thing. Absolutely.
Thank you.
Absolutely. Okay. So we were looking at 548, 549 on the call side is where we were looking, right? And we determined we're going to be in the bid column, which is the $20. Once we select this 20 here, we're going to see that we're going to go again to the red boxes. We are selling a SPY, one contract of SPY at the 548 call, and we're buying one of 549 call. We're going to receive $22 in credit, and we're going to leverage or have collateral of $78. Somebody say whether or not, well, let's do it this way. If you're clear, really clear on what's going on with the money, or what I'm saying as far as the leverage and collateral, give me a 1. If you're not clear on that, then give me a 2. Okay, I see some 1s, lots of 1s coming in. Okay, this is probably one of the most confusing parts of credit spreads is understanding what's going on with the money. And I've got some more charts we're going to go through talking about the money too. We're going to continue to talk that because people are like, I don't know how to get out. I don't know how to get in. I don't know what to do. I want to make sure that we're clear. I hear you, Maria. We'll keep talking about it. And I believe it may clear up along the way. If it doesn't, then ask me again for sure. Okay. Make sure that we're clear before we leave here. Okay, so I've showed us the put credit spread and the call credit spread of that exact same trade we just looked at. Let me see, what did I have next? I think I had next to do a trade from start to finish. Yep, I did. Okay. That's what I did. Let me go back to that then, because I wanted to do that. I'm going to turn on my on demand. Thinkorswim has on demand. I'm a fan, by the way, of on demand because it allows you to back test and practice stuff in a live environment when the market is closed, open or closed. You can use on demand whenever you want to. If the market is open, you can be in your sim or your paper, but if you've got on demand, you can practice and use this anytime you want. You can use on demand anytime you want. You basically pick the day you want to go back to, pick the time you want to go to. The option chain does all the things. The chart adjusts itself to that time. It does all of this for you. Okay, I'm going to do a triple Q trade. One of the things that some of us do is we enter 1-day credit spreads and then we exit them the next day. Enter 1 day and exit the next day. So I'm going to do one of those here. Going to show us our example of entering. We can see what the money looks like. We can see how the process flows, and we can see the exit. We can see all the pieces and the parts. Okay. If Come on demand was doing good earlier today, I wanted to come on. You were doing good earlier. Come on, darling. You know, they who's the people, Thinkorswim, they every weekend you open Thinkorswim, but they're like, Thinkorswim is undergoing maintenance. They be working on the weekend. I love it. I love this from the standpoint that they're always continuing to work on it. Sometimes when you try to use it on the weekend, though, you're like, oh, you gotta work on it right now. I'm trying to use it. I'm trying to use it. I'm trying to use it. Okay, I'm gonna go to the trade screen. Maybe it'll bring up what I need. Come on, darling. Open the chain. Ooh, it was working earlier. I think it's because I'm running more stuff now. I wasn't running Zoom before when I was running it. While it gets itself together, anybody got something they want to ask or say? I need the trade grid. It act like it's showing me. It's not even act like it's still trying. Like, I know where I'm there. No, you're not, though. Let me make sure I am on the right.
Arlissa, quick question while my hands are free. On the okay, say they take the collateral, the spread is 100, and they take they give you 20, and 80 is the collateral, right? So if the trade goes your way and you win, you get the 100 plus the 20, right? The 20 they gave you, and plus do you get back the 80?
You just get the 20. Okay, good question.
They release what, 80, or do
they
release
gave
the
you,
100?
they released the 80, yes. So when you enter the trade, they give you 20. When the trade goes well, it's all over. You get to keep the 20 because they give you the money right away. So you keep that 20 and they release the other 80.
So that's still the 100 that you went in with.
Right, but they didn't. So they didn't. They basically are releasing your money back to you, because it's like when you take your, when you go into deposit money into like you rent, like you're renting a car, and then they block up the certain money on your credit card. Right? They haven't taken it; they just blocked it away. And when you bring their car back, they release the money back to you. That's the same thing that happens here. That when you enter this trade, they block away the $80. And when you return, when the trade is over and the trade is closed, they return your money to you.
Okay, they return the 80.
They return the 80. And they gave you the 20. So they return the 80 back to you.
Yeah, so that's what I'm not understanding. Because if the spread is 100 and they giving you 20 and holding 80, they giving you 80 back, and you just getting the same 100.
You're getting the same 100. This is true. I guess you can look at it like that. Yeah, you can look at it like that. You're getting the same 100. Yeah. True. But they gave you 20. They gave you 20. So you really only gave them 80. You really only used 80. So when they release your money, they're releasing 80 back to you.
Yeah, so you get your 100 back.
Okay. Yes. I'll say yes. I'll say yes to that.
Okay. Well, we'll talk more about it.
Okay. I'll say yes.
I understand that part. Okay. Thank you.
And so the reverse would be you would lose the full 100.
You would lose the 20 they gave you and the 80 that they blocked of yours. Yes.
It's the win I'm not understanding. It's like you winning the same thing that you put up. But
You didn't put up 100 though. You only put up 80. They gave you 20 at the beginning, and then they blocked off 80. And when the trade is over, they give you that 80 back. So you only have $80 in the trade. You don't have 100 in the trade. You have 80.
okay. Okay, got you.
Okay.
All right, thank you.
Yep. You're welcome. Okay, so I was looking at the triple Q. Let's look here at our probability out of the money. Y'all looking here on the put side and the call side. Tell me where you see where would be good strikes for our put credit spread. What would be a good strike for our put credit spread? Put credit spread is on here. What's a good sales strike for our put credit spread?
Without the chart, so we're just looking at the high delta?
I'm just gonna start here. I'll go to the chart in a minute, but based on what we see here, what do we see is a good strike?
471.
474.
474. Probability out of the money over 75%. Delta less than 25. 474. Very good. On the call credit spread side, what do we see as a good strike for our sell leg on the call side? Probability out of the money is here.
What the hell?
What do y'all think?
A 43? Well,
Well, my thing's going crazy. 483.
or this.
We like that one, or
Well, yeah. Either one.
I like them both. 74.64 is a good, it's right at our 75 mark. The delta is a little bit higher than what we, suggested. 79.1 and the 21 would be probably safer, just a little bit. It's gonna come down again to your comfort level. This puts us at 484. 484 on the call side. So we got 484 and we got 474. What's our plus minus number? Oh, we don't, you know what? You don't get plus minus number in on demand. That comes live. There's no plus minus number there. 474, 484 is what we're looking at. 474, 484. So now we're going to change this to, let's go look at the chart. Hopefully on demand. There we go. Will work with us in a reasonable fashion. 474 and 484. I'm going to take and clear all these things off. Looking for our support and resistance. I see support right here in the previous day candle. That's at 474.72. Resistance would be at the bottom of that gap. Top of the gap. Is there anything between current price and there? I would say yes. There's some stuff back over in here. One way you can do, if you're just for those who chart, you can change it to a line chart and see if you see anything that's a place where it could be some resistance. And I see something right back here in the June time frame where price, you're looking for peaks and valleys. Remember, that was what we talked about earlier in our call. We're looking for peaks and valleys. Peaks and valleys. Okay, I'm gonna put it back on the candles. So I've added some lines. Let me get us back to where we can see what we're looking at. There's some resistance at 481.66 based on this little slowdown right in here. The next resistance up is at the 485, and that was based on something a little bit further back. Oops, sorry, y'all. 485, oh, come on. There we go. 485 is based on this area right here, back in June. Are we comfortable with the 474 and 484? $474, $484. Okay, I'm going back to the trade. And I'm going to switch us over to vertical. Let's look at the put credit spread side first. It doesn't matter which one you look at first, or if you look at them, you know, individually. Now, I'm going to talk a little bit more about iron condors here in a minute, but I want to show you put credit spreads and call credit spreads. Sometimes you only do one. You do only the put credit spread side. Sometimes you do only the call credit spread side. And sometimes the chart gives you the presentation or give you the position or the opportunity to do both sides and make it into an iron condor, which we'll talk about those soon after we finish these, okay? So we looked at 474 was our strike price that we said. Let me get us a pencil. 473, 474 on the put credit spread side. We're going to select the bid column. We're taking in $19. How much is that in collateral? $19 premium leaves us with how much in collateral?
81.
$81 of our broker is going to block away $81. They're going to give you $19 immediately. The broker is going to give you $19 right away for each contract. You do multiple contracts, you get multiple $19, right? So if you say, I want to do 5 contracts of this, then they're going to do 19 times 5. A little bit less than 100, that's because $95. They're going to give you $95 and block away 81 times 5 because they're the same, you know, just like you multiply this times 5, you also would multiply your collateral times 5. Okay. I'm going to enter us into this trade. Okay, confirm and send. I want to show you what it looks like once you push confirm and send, and we'll look at what this. Well, what was that? That wasn't the plan. There we go. Let's go back to sharing. Sharing is caring. Here we go. I was trying to get my pencil to erase some stuff. Okay. Notice you say here that you're going to sell one vertical, triple Q. It's got the strikes and stuff for you that it puts in. You're going to collect $19. Break even strike price. So what if the price goes as low as 473.81 will be your break even price. Your max profit is $19. Your max loss is the $81. Basically, the cost of the trade in parentheses means they're giving you the money, and the buying power is going to be affected by the $81. When you're cool with that information, with this information, then you push send. We entered the trade. We in, baby. We got $19 they gave us right away. Our other side was 484. 484, 485, and we're going to the bid column. Collecting our $19, or in this case, $21. We're collecting $21, which means our collateral is $79. If we were just doing the call credit spread side. In our case, we're doing both sides. We're going to talk about how that works out for us in our favor here in a minute. To do both sides means you have to put up less collateral. Confirm and send. Basically, we're going to trade triple Q as a call credit spread. 484.21 is your break-even price. If the price goes up this high, max profit is $21. Max loss is $79. Okay, we're going to send it. Send it. Now I want to take us to the monitor tab because I want you to see. I want you to see what's going on with the money. I'm under monitor if you're in Thinkorswim. If you're using a different broker, I can't really tell you where some of this stuff is. I can talk a little bit about Robinhood, but Robinhood doesn't show the way the money's going either. You can go to the main screen and sometimes be able to see it. Robinhood is not the clearest way to see it. But this is what's going on with the trade. Okay, I'm going to drop this box down. You can see exactly what trade we have. We have one put credit spread going. These are the put, both of these together make the spread, right? It's set for tomorrow. Today is the 22nd. Basically, we're entering on the 22nd, and we opened it for the next day, which will be the 23rd. The trade price, the difference between these two is what you actually took in premiums. This is the money, the trade price is what they gave you. Trade price, what they gave us. That's what they gave us. They gave us $19 for the put credit spread and $21 for the call credit spread. I took 84 minus the 63. That's how I got 21. Okay, the difference between these two is what it tells you how much money you take in. On this one up here, we took 88 and subtracted 69. And that's what equals the $19. Okay. As we're going, the mark is the current value of the trade. Notice these numbers are moving. The mark keeps moving around. As time progresses, that price moves because it's the current price of what's happening now. The trade price doesn't change. What you took in is not changing. It's what the mark is what's currently happening. What's the current worth of these two? And to find out, to see what is the current value of your trade, is you again take the difference of the two things that go together. Take the difference of the two things that go together. That's how you know what's currently going on. Looks like this one's around $20. It's moving, right? It's 21 again. It's now 20. These are moving. So, and we've only been in this trade for a few minutes at this point. I'm going to take us to the end of the day so you can see this trade doesn't expire until the next day, but I want to take us forward to see what happens at the end of the day on this trade. I'll change this to 15:55. End of the day. It's buffering now. It'll give us some new numbers. It's going to update. This is why we like on demand. It's like real life of what's actually going on with your trade. While you're practicing, it's a good way to practice. Is it still buffering? Yes, it is. Come on, baby, you can do it. Okay. Now, if we're looking here at current price, the current value, mark is the current value of the trade. Mark is the current value. So the difference between these two now is $6. It's about $6. We started with 19 and it's now worth $6. So we could buy it back for $6. We've sold it for 19 and we're going to buy it for 6. And the difference between those two is the money that we keep. All right. That's what be $19 is what they gave us, right? If we're going to buy it back for $6, that means we would keep 13 of these dollars. If we bought it and closed it right here, if we close it right here, right now. we would keep $13 of profits. Trade would be off. They would release the collateral. If all you had was this one side, they give you your money. The other side, though, because price is moving, the difference between the calls is about, what's that, about $34? Okay, we took in 21 and now it's worth 34. So this trade is in the negative right now because they gave us 21, and if we were to buy it back right now, we'd have to pay $34. That means we'd be about $13 in the losses. Be $13 in loss. That's why this whole overall thing here shows that you're down 8% because it's counting the whole thing. Right? You're looking at the difference between the calls and difference between the put. The whole thing, though, is still worth, is that 740 something? This is current value, but I want you to know that mark is what's currently going on. Let's move to the next day. Move us to the next day. We can see what do these numbers look like after the day passes. Okay, it's buffering. We went to the next day. I want to get a different time. I don't want to go at 4 o'clock the next day. I want to do, let's see, like when the market opens around 10 o'clock. What are things worth at 10 o'clock? Come on, work with me. Work with me. Work with me. There we go. Okay, it's 10 o'clock in the morning now. What do we see? Where's my pencil? There we go. The difference between the current market's current price, the difference between these two is $3. Difference between these two is that $35. It's changing. We're watching it do its thing. Looks like that's $28. Y'all see it moving? Lets you know where where the profits are. As time passes, this continues to close. Now, what I do is, which I will show you to do, is we look at closing them when they're at a good profitability. We took in $20 on this put credit spread. We took in $20 on the put credit spread. So if I close mine about 50, 60%, but you can close them, closer. You can let them expire worthless. Just so you know, they can continue to go. If they're not at your strike, they can expire worthless. I generally close mine 50, 60, 70%. I will close my spreads, right? So I highlighted, I picked the put, I picked one of these, and then I use the control and pick the other so they both become blue. And then right click, it shows create closing order, and you want to buy the vertical. Highlight the ones you want, create closing order, buy the vertical. It says here that I can buy it back for $3. They gave me 19 initially, and I can buy it back for $3. If they gave me 19 and I buy it back for $3, that means I get to keep $16 in profits. Right? I collected $19. They gave me $19 at the beginning. I'm going to spend $3 to buy it back. This, of course, I'm not incorporating fees. That's something that you got to look at. How are the fees? It's about $1 per spread plus a little bit more for stuff. So it just, know that the broker is going to take some fees. And then that would be about $16 in profits minus fees. Now it's worth $2. And you can change this box to whatever you want to change it to. Let's say I didn't want to buy back until it was worth $1. I could change it to $1. You can't put zero, because if it's worth zero, you can't buy something that's not worth anything. So it has to be at least $1 if you're going to manually try to close it. Otherwise, again, you can leave it to expire worthless. I don't like to worry about that. It's 10 o'clock in the morning. If I can close this trade earlier and have this off, have my collateral released, I can go use my collateral for something else versus waiting all day hoping that the price doesn't go against me. That's me, though. Some people really want to hold it out to the last 4:15, and I'm not that person. If it gets to past 50 or 60% profitable for me, I'm good to go. I'll go put my money on something else and let that trade worry me. Okay, so anyway, if you want to buy it back for $1, you can adjust this, change it to $2, whatever you want to. And when you're ready, you confirm and send. Basic says you're buying it back for $2, buy to close, and that order will work until it's ready. When I go up to monitor under working, it'll show here that I'm asking for $2, but the current price or the mark is $3. I'm asking for 2, but it's currently at 3. So it's going to sit here until it's worth $3. When the mark gets down to $2, when the mark gets down to $2, it will fill this order. Okay, but this is, you can put your close orders on early. Whenever you're ready, when you're in the trade, you're running, you know how much you want to close it for. You can set your close orders early and just let them fill when the price gets there. All righty, so looking at the call credit spread side, select both of these and right click again, create closing order. It says it's worth $33. Well, I received $21. So I don't want to close it for 33 if I don't have to. So I'm going to set my close order and then I'm going to let it work. As the students say at my class, let it cook. Now, I'm not sure why they say that, but they do. So I don't want to pay $30 for it. I really would rather pay, $5. We took in 21. I want to close it for $5. That'll be about 75% profits I'll get to keep. So I put in an order for $5, right? You can put in what you want. Just know, putting it in here doesn't mean it automatically happens. Like, oh, I put that in, it didn't feel. It's not going to feel until it's worth that. It would be wishful thinking. I want to pay 5 for it, but it's worth, no, I said 5. I want to pay 5 for it, but it's worth something else. It's not going to matter. I put 05 in there and it closed that at 36. That is not what we wanted to do. Okay. I need to pause this and go back because I want to make sure that we have it right. So I can show you how you can see it. How you can see it going back down, going down. I'm going down. I want you to see it, 484, 485 on the call side. Take me back. Take me back. Think or swim to the place. What y'all know about that song? Y'all know anything about that song? Are y'all still with me? Y'all getting tired in here? We're cooking along real nice. We're cooking along nice. Don't wear out on me. I tell my kids, don't throw in the towel just yet. Valerie says, still here, still with you. Wonderful. Y'all don't die out on me yet. Y'all hang on. Hang on with me. Okay, I have 484, 485. I want to go ahead and enter that again. Right, and then we can move back forward. We were at, we can go to 12 o'clock again. I want to go to the 23rd at 12 o'clock. Okay, I want to go to the 23rd at 12 o'clock. Okay. And we can go to the trade screen, monitor, and see what's what. Come on, Cletus. Yes. Stacy said, I know the song. Yes, we know the song. Okay. So that, I'm going to pause this now because monitor under the working field, because the one I put in I put in the order to close me at $2, right? It filled that order. Look at 12 o'clock, looks like it filled that order to close. I just had set it and it'll close when it's worth that, it will close, right? When it's worth that, it'll close. So now I want us to look though at this call credit spread when that is still going. It's not ready to close yet. I've got it set. I'm gonna let this keep going though. I've got it set. I'm gonna right click again, both the blues, right click, create your close order. It says it's worth $40, right? I don't want to pay $40. I want to pay 05. I'm gonna get off this screen now. Maybe it'll, when I hit the tab, and perhaps it'll do like it's supposed to now. I'm going to the next place. It needs to not act crazy though, because I want to set it so we can see it working. Under the working trade, it says here, I want to pay $5 for my price. This is what I want to buy it back for, but it's currently worth $38. It's currently worth $38. Now, what you're looking at along the way when you're dealing with these, we have 484 as our call strike. So our thought is that we don't want the stock or the stock price to be above our 484. We don't want stock price above our 484. Right? The reason price has gone up because as we were watching it, it did get up into the 484 area, but it has come back. It has come back down. And your desire, of course, is that it needs to expire below 484. That's what that trade means. I want it to expire below 484. Right? You don't want it there. You want 484 was our strike. And we don't want the price to expire up above 484. That's what our trade says. It's like we're coming on back down. Let's move us forward. We'll put us at 2 o'clock. You can see what's going on. Now, this is where sometimes people will be, if it gets close to your strikes, you'll be like, oh, I don't want you up here by my strike. That's where that can be a little nerve-wracking, right? We don't want that at all. We want it to act right. We really want you to act right. Right? This gives you encouragement because we have 484. It's currently at 482 and going down. Yes. Let's go see what it's worth now. See, I want 5. It's now worth 23 or 24, where before it was in the 30s. It was in the 30s. So if you get to a place where you think, okay, I would like to have 5, but I'm willing to get out for 10, you can always change this to something else as long as you're going to keep a profit. The whole point we want to be is we want to keep a profit. We want to keep a profit, all right? Who's got questions while I move this forward? Anybody?
Hi, I have a question. So, would you mind showing us what that looks like in the transaction history, like when we close? Like, so when we're so for example, like I'm doing the calculations on like that you're showing, right?
Okay.
And then when I look at my transaction history, I just want to make sure, like when it shows up on my account, I'm trying to validate that information.
Okay.
And they only put like what you purchased it at versus like if I, so I've been subtracting to try to do the difference, but I'm not sure that that's 100. I'm doing 100% correct. Like,
Okay. So what happens is, and Jamie may have to step in because he, of course, looks at his really closely. But when you enter the trade, they give you the premiums. They give you that right at the entry. So you're going to see that on your transaction history. And then, of course, they're going to, for Thinkorswim, for sure, is going to take away the fee. So now Thinkorswim, I have it set where, okay, let's say we look at this one where the $21 is. They're going to give you the $21 in the transaction history. For me, I pay 50 cents per leg for each time you enter and exit a contract, I pay 50 cents. So they're going to take away $1 because this is a 2-legged spread. Spread has 2 legs. So 50 cents times 2, they're going to take away $1. just a $1, not $100. So this is not in the $100, you know, you're not multiplying this times 100. You're just going to take away $1. All right. So there's $20. If I buy it back, like the other one I had, I bought back for, what did I say, $2. So I bought it back for $2. They're going to subtract $2 more from that because I paid $2 to buy it back, which is 18. And I paid another 50 cents in fees to close it. That's another $1. Even though Thinkorswim, I think they say they don't charge you to close it if it's less than $5, but I don't know that to be true. I've heard that, but I don't know that that's what happens. So at this point, you're at $17 of your profits minus whatever extraneous fees. And I don't, you know, they've got some other fees that aren't necessarily contract based. So let's say I would probably say another couple dollars. I don't know this part. So this part is a question for me, is what's that extra fees, here. If you took away $2, I would say then you should end up with $15 of profits from that trade per contract. Now, how that looks on the transaction history, that part's questionable. Yeah.
Okay. But so essentially we should expect to see the same thing on our transaction history.
You should.
Fees
You should.
To verify. Okay.
You should. Yep. You should something very similar. You should be able to see some similar stuff happening.
Okay. And then if, let's just say we enter one, like a sell credit spread, a call credit spread, and it expires out of the money or something, and we don't close it. We just let it expire.
Okay.
Now, I read like it shouldn't show up on your transaction history, like it just kind of disappears and the account settles. Is that different? Is that,
yes, that's what
am I
happens.
understanding correctly? Okay.
Yep, you are. So the two things I had this was our buyback number, and this was the amount we paid to close it. So these two should not come out because you didn't buy it back and you didn't close it. So you should actually have an extra $3 as far as that. Now the closing of it does look like when it just expires, like I said, just kind of disappears off of there, and there's no more fees to pay off of it because you paid the fees to enter and you're not going to pay the fees to close or to exit. So there shouldn't be anything else there.
But our account balance should increase, right? Like
it should have increased when you first entered it. It should have increased right here.
Oh, okay. And then okay, because like you said, they're giving us that money up front. Yes, so it should increase up there, and then it wouldn't show up, but it would show up in our account. Okay, I'm following. Thank you.
Yep, they give you the money right away.
Thank you.
You're welcome. So as you can see, our trade is still kind of drawing down. The current price of, we can look here and see the current price. So you really don't have to, you can be on the chart because you want to see what's happening on the chart, but the current price of triple Q is actually showing up here in your monitor tab. It's 482.25. You look right across from here. It shows you what is the current price. It's at 482.19. Of course, you want it to not be at your strike. 484, we want it to not be there. It's what, 3 o'clock? I think I put us at 3:30 is where we are. It's at 430.32 is our current price. Let's take ourselves to, we can go to, let's say 58, 358. Now, triple Q goes till 4:15 for the triple Q's. SPY, they go till 4:15. So you got a little bit extra time after the regular bell rings. You got a little bit of extra time on those to enter and exit. So, definitely keep that in mind if you're doing the indices. Okay, I think we're on a good pace. I think I've got about 30 more minutes worth of data to go through information. So if y'all are comfortable, I think I said we were going to do about 3 hours. I'm thinking we're going to be a little bit shy, but I want to make sure I'm answering all the questions and I don't want anybody to feel like I'm just dragging it out. Current price is at 480. Looks like our trade just filled. Maybe. Where'd it go? Where'd you go? Did it disappear? Shows here that it's worth $10. Where am I? Did I exit it? Did it cancel? Oh, well, maybe it canceled at 4 o'clock. Yep, it expired at 4 o'clock. But because the price is not at our current price, it would expire quote unquote worthless, but we do got 15 more minutes. I wonder on Fridays, do we remember whether it expires, it closes early on Fridays? This isn't a Friday though. This would have been a regular day. This would have been in the middle of the week. But yeah, see how it's drawing down here though? It's now worth $6. It was jumping around 12. It was 6 a minute ago. Price is still at 481. Again, we just need to make sure that it does right up until, this is one of the reasons why I close mine. That I close them before 4 o'clock because I want to make sure that it's closed. I want to be sure that it's done what it was going to do. And I can be finished with it. Looks like it's dancing around. I'm going to put in for $6, see if I can get us to buy it back. I wonder if it'll come back and say, it shows working still. But now it's not worth anything. So I'm saying I'm willing to pay $4 and it's worth negative $4. It's worth nothing. So it's like, you can't get money out of nothing. So you can't close it. That's why I always got to make sure mine are closed. So that way I know that it's done at 4:15. I don't have to worry about what happened next. I know it's done. I know that it is done. I'm going to change this to a market order. That way it'll pick up wherever and it'll close it down now. It should anyway. All right. I want to go back to what questions do we have before we go back into our slides? I want to talk the money. I'm going to I have some charts that show the money on the charts. I want us to look through those. I read somewhere they can choose to exercise the contract early. They only exercise contracts after the market hours. So exercising and stuff doesn't happen during the day. Any exercising and all those assigning, all that stuff happens after the market is closed. So it can be early from a standpoint of before the expiration day, but they won't exercise during the day. Okay. The money of credit spreads. We want to sell high and buy low. We want to sell high and buy low. Like we sold at 19 and bought back at 3. We sold at 21 and bought back at 4. Or you sell somewhere and let it expire worthless. You want to sell at one price and buy it back lower. All right. You collect the premium when you enter and you want the money to get lower as the trade progresses. Theta decay works for us. Theta decay, which works against buyers, it actually works for sellers. It's eating away those premiums, right? This is the trade we were just looking at. We were just looking at this one. The money you receive when you enter the trade is the trade price. And I circled the 2 puts and the 2 calls because those go together. The difference between these 2 is the money that you received. Right, 68 minus 87 was the 87 minus 68 was $19 we received there, and the 687 minus 65. This was earlier in the day. Looks like that was $22 I received there. Mark is the current value of the trade. Whatever time you're looking, mark is the current value, is the value what it's worth at that time. And for spreads, you always want to look at the difference between these 2 numbers to find the value. Okay, this was the 22nd when we entered the trade. That was the day I used to enter the trade. And then I went forward to the 23rd to show you how things were changing. So this we received 19 here. We received 22 here. On the next morning, this was worth $4 at 10 o'clock the next day, and this was worth 30. Okay, so we received a total of $41, right? If we add these 2 together, we received a total of $41 in premiums. The next morning, this trade is worth $34. The difference between these $2 right now is $7 of profit. If you closed it right where it was, you'd have $7 in profits. That's because you took in $41 and you're going to close for 34, not counting fees. When I talk about profits, I'm not counting in fees, right? $7 profit, you got P&L open about 750. It shows right over here. That's what the P&L open, P&L percentage says that this trade is 18% profitable right now. The P&L open is $7.50. Okay, when I talk about closing at 50, 60, and 70%, that's what this number is. This P&L percent is what I'm looking at to close it at 50 and 60, 70% profit. Then I'm going to move us forward another day, not another day, another few hours. Did I put another chart there? I hope I did. Yes, I did. That's supposed to be 10 o'clock. Nope. Oh, I wanted to say, how do you close these out, which I showed us just now on the option chain? You select the two you want to close. Select the two you want to close and you right click and select buy vertical. Select the two you want to close, right click and select buy vertical. That's how we close. Same thing for the calls. You would select these two calls, say buy vertical. But you could, honestly, if you wanted to, you could close all four at the same time if you so chose. Okay, this is what that close screen looks like. The amount you'll spend to buy the close is 0.04, and you can change whatever you want in this box. You can change this box if you want. Okay, now the example I showed was us buying back and we're going to be profitable. Sometimes the trade is not profitable and you may want to buy back, you know, for $40 or $50 to reduce your loss. Because if you took in 19 and the trade gets to be worth 40 or 60, you might say, okay, this is not going the way I want to go. And I want to just close for a smaller loss. I don't want to have max loss. I want to have a smaller loss. I can close it there and turn off the trade right there and cut off. And, you know, basically, as they say, cut your losses. And cut your losses there. Okay, winning the trade. If the price ends away from your strike, then you win and you keep all the premiums. So if we're looking at that trade where we had 484, 485, and price stayed below 484, right? Then you would keep the total 100%. If you wanted to just let it expire, you're going to keep that whole, I think it was $21 we had on that trade. You're going to keep the whole $21 below the 484, as long as price expires below 484. If price ends though beyond your buy strike, so beyond 485, let's say price is over 485. If price was to close higher than 485, then that would be called max loss. Max loss. We took in $21, so we would lose the other $79 of collateral. The collateral that we had of buying power that the broker had set aside, we would lose that $79 if it expired at max, expired beyond 485. If price ends between your strikes, so somewhere between 484 and 485, somewhere in there, if it expired somewhere between 484 and 485, then you're going to pay what it's worth at the time. If it's between those two strikes, it might be worth $20. It might be worth $50. Depends on what's going on, but it's gonna basically be worth what it's worth at the time. Depends on the location. Closer to your sale strike is gonna be less. Further from your sale strike is gonna be more, but it's not max loss. In this case, it would not be max loss because it's not through both strikes. So it wouldn't be the full 79, but you may or may not keep the full profit. That's your $21. Questions here? All righty. More money with iron condors. Iron condors basically is where you do put credit spreads and call credit spreads together, like what we just did today. We did them both. You're doing them in conjunction, and then you're only using the rest of that money in collateral. You don't have to put as much collateral up because you're taking in more money. If we look at the trade that we just did, I want to say we didn't have 21 and 22. We actually had 19 and 21. Is that what we had? I feel like we did 19 and 21. So I'm gonna make this 19, which means we would have taken in $40 and our collateral would have been $60. So you don't do two 100s. You take in more money, so you offset the amount of collateral that's required. You received $40, your collateral is $60. In this case, though, we needed price to close between 474 and 484. We needed price to close in the middle, so below the call credit spread and above the put credit spread. We needed price to close in the middle somewhere. Don't have to be exactly in the middle, somewhere in between here. We needed price to close. It could be at 475 or 483 or wherever, as long as it's not down at past 474 and it wasn't above 484, we would keep our whole $40 and then the broker would release our $60 to us. Iron condors, they allow you to make money on both sides and get the most out of your collateral. Where before we did $21 and we had $79 of collateral. Or if you only did 19, you would have had $81 of collateral. But when you put them together, you collect $40, which means you only have $60 of collateral that the broker is going to block away. Make sense? Those are called iron condors, doing a put credit spread and a call credit spread together. Put credit spread and a call credit spread together.
For the iron
Okay,
condor,
Janae, huh?
I said for the iron condor, if one side of the spread is, I don't know,
Breached.
maybe you got 60 cents or $60 in premium. Should the other side be 60 or less than 60 preferred?
No, it doesn't matter.
So could it be higher?
It could be. You taking, if you take in 60 cents though in premiums, you're mighty close to current price.
Well, so because I know you say that you don't have to get into the iron condor
At the same time,
at the same time.
Yeah,
So I know I've entered one maybe the day after, and of course it was definitely price action. And that's the other reason why I entered it, because my other leg was going to crap. So I'm trying to hedge bet. And so that's why. I just kind of want to get better clarity.
Yeah.
If I should be going for the same premium amount in terms of keeping the collateral the same. So that's where I'm asking.
So if you take in, for example, $60 on one side.
Yep.
Okay, that means you've got $40 of collateral. And let's say that trade is not going so well, right? And you decide to get on the other side and you take in another $60, then you're in profit regardless. Right? Because then this is going to supersede the $40 that would have been your max loss. So you're automatically at $20 in profit because you took in more money than was your max loss from the first trade.
So it's advised to get in at a higher?
If you
premium?
you
If, right,
can.
if
Now
you
you,
can, that's
if
true.
you can, that's if you can. What I have found that sometimes when, let's say on one side, you've only taken in $20, which means this is $80 of collateral. And to find another trade, to find a trade that you're taking in $80 is not going to happen. So what you can do then, maybe you look for something and you take in $30. So then now you only have a $50 loss because you've reduced the loss by taking in by doing another trade. I don't find this over here happening as often as this over here.
Right. They tend to be different premiums.
Yeah.
I guess I'm gonna ask it two different ways. If I got in for lower, like the second one, I got in for 20 and it was $100 spread. Are you saying I could get in on the other side for higher and the same collateral? So I guess in other words, it doesn't matter. The collateral will still be the same regardless if I get a higher or lower premium. That's
right.
Really my that's really my hesitation when I don't get into an iron condor. I'd be worried about, am I really gonna get the same?
You are.
Okay.
So $20, the broker is using $80 of collateral, right? So, and then you enter another trade. You say, well, I'm gonna get in on the other side and I'm going to take in $25, let's say. Well, now the broker gave you $25 more. So now your total collateral is the 80 minus the 25. Which is what, $55 is your collateral now? It's still a one spread on both sides, but the broker knows the price can't be in two places. So if you've got one of these is at 474, right, is your strike price, and one of these is at 484, the price can't expire in both of these places. It can expire here or here. It can't expire in both. So one of these trades is going to be max profit regardless, which is why the broker doesn't take two sets of premiums or two sets of collateral, because they know the price. One of these trades is going to be full profit, and one of them could possibly be full, max loss, but they both could be full profit depending on where you're located, but both of them can't be max loss. One could be max loss and one max profit, or they both could be max profit, but they both can't be max loss.
Interesting. So are you saying, okay. But I get both premiums up front.
Yes.
Okay. The reason I got a little thrown off was when you did 80 minus 25 versus 80 minus 45.
Where do you see 45? Or you added these together? No, because the 80 was based on the rest of this 20. That's where 80 came from. After you were already given the 20, then that's $80 of collateral. You entered another trade that took in money, so you could take 80 minus 25, which leaves $55. Or if you want to do the full 100 minus the 45 that you took in, that's $55 of collateral.
Okay.
Yeah.
I know, and I'm still, all right. So the collateral, I can get a higher premium. That's good to know. Of course, if possible. And then is it really just, is it the higher premium that I need to be worried about regardless of either side?
Not necessarily. I mean, you need to be concerned about where the price is and where the price is going. Generally, higher premiums mean price is closer to it or price is coming in that direction. So that from that standpoint, yes. But you just need to really be most concerned about what is price action, and where is it going?
Where is it going? Okay. But in terms of where it ends, in order to get
Right.
the full amount. Okay.
Okay, so Maria's asking, when should you, when is it best to trade iron condors? So generally it's good to trade iron condors when you see consolidating price action. If there's consolidating price action, it's a good time to do iron condors. If you can look here, you can see that on some of these days, which you can't identify these days early per se, but sometimes you're looking at a daily chart. I might need to come out of on demand, because on demand will slow it down. But I'm on the daily chart. Sometimes when you see a price has been consolidating for a while, like IWM for a long time was in a consolidation mode. If you're looking here, triple Q is not always the best example because it's been moving a lot here recently, but IWM in those areas will just kind of consolidate. But when you see consolidating prices, or you think it's not going to go from so far, these are good iron condor days, right? Triple Q. Most times the market is not trending hard in one direction. We've been seeing a lot more of that here recently, but generally there's movement up and down, but it also can stay between ranges. We go to, like I said, IWM, which IWM has recently decided it was ready to be on a horse. So, but before that, IWM has consolidated. You can see this has basically been in this zone for a long time. Nope, that's not what I wanted you to do. But it's been in this zone for a while, right? So when something is consolidating, or when you don't feel like it's going to move outside of these bounds between now and expiration. So I do them on triple Q. I'm going to talk about that here in a second. I can actually slide into that next, but I do them on the indices based on some alerts that we get from PeakBot. And it's a 1 day because it's not a long period of time. It says, okay, I'm entering today with the thought that the trade won't go outside these bounds by tomorrow, right? So you using your plus minus number, use your probability of the money, using price action, watching to see that I don't think it's going to go out of here between today and tomorrow. Or something's been trending for a few weeks. You're like, well, it's kind of staying in the same spot for several weeks. I believe it'll stay here for a week. So the trend is neutral. Notice how this moving average is a 50 moving average. It's kind of sitting still. It's not going up. It's not going down. It's just kind of sitting. These are perfect iron condor. Of course, IWM decided it was ready to move about a week ago, 2 weeks ago, and it's been doing just that. But for a long time, it wasn't. This was like good iron condor opportunities right in here. So it's going to be, sometimes we'll identify iron condors based on the neutralness, and then we'll enter a put credit spread 1 day, and then enter a call credit spread a different day. So you don't necessarily enter them on the same day. You can, but if you're doing them on something that's going to take several days for the trade, you may want to do them on separate days. Guy says, to place orders for iron condors on Schwab, do I put in 2 vertical orders or use the iron condor? I would suggest doing the 2 vertical orders. I would suggest put credit spreads and call credit spreads, because if you do it as an iron condor, and I'll open this up, as you do it as an iron condor, you have to adjust these strikes yourself. So if I was doing this here and I was changing this to an iron condor, I would have to, it just comes in 4s. It comes in like 1, 2, 3, 4, 2020, 221, 222, 223. So I'd have to know what strikes I wanted, and then I'd have to put those numbers in myself. And it's an opportunity for something to go wrong, for you to get it mixed up, or for you to, put in the wrong strikes. It's just an opportunity for stuff to go awry. But I'm going to show it to us, like that trade we just did on triple Q, where we were looking on the 22nd at 12 o'clock, and we were looking for 483 483, 484, 44, 85, something like that. We were up in there. So you'd have to pick one of these. We were at 74.84, right? So I'm just going to select one because we're going to have to change. You got to change stuff anyway. But this is how it looks. So you have to remember what you wanted. So on the call side, we had, I'll change this to, I think we had 484. And then on the buy of that, we had 485. So you have to put in your own, nope, I wanted 485. You have to put in your own numbers. And again, I feel like it's an opportunity for error, but I'm not saying don't, just saying I think it just takes a little bit extra effort. And if you're trying to move, stealthily and quickly, you may not want to push the buttons all separately. And under the bottom, we had 474 was our sell leg and 473 was our buy leg. I'm going from memory here. That took in $41, $42 is about what we took in when we entered it. And you're going to say, you're here, you're putting in all 4 of these legs, you're taking in $40 in credit, confirm and send, and it's going to tell you you're doing an iron condor. What are your break-even prices? Price needs to be between $473.60 and $484.40. Your max profit is $40. Your max loss is the $60, which is the remainder of the spread. Remember, the $100 minus the $40 they gave you. Your max loss and collateral is $60, and that's what they're going to block away of your buying power. And when you're ready, you could just push send, and it collects it, and then you're ready. And then you can close it. You can enter it separately. You can close it separately. You don't have to leave it. You don't have to close all 4. You can close just the 2 and just the 2. You can enter them separately and close them all together, or you can enter them together and close them separately. Up to you. Di says your method is easier. It's definitely quicker, right? That extra pushing buttons and hoping you don't miss, especially if you're working it on your phone. I've just done it a few times and then been frustrated because it just didn't do right on your phone. And you're like, oh, I need the right numbers. So, okay. All righty. We're at a good point. Finding the stocks for these credit spreads, because how do you may have stocks that you watch all the time, which I think is great if you're trading things that you like and you can do it that way. Go with that for sure. You can go to barchart.com. Barchart.com does have barchart.com does have an iron condors thing here. I'm a fan, but not a super fan. And that's because unless you're paying for bar chart, you don't get to really see what brought them to your numbers and why they picked these strikes. So you under options, you can select vertical spreads. You can pick the bull call spread, no bear call spread. You got to remember, they used to have vertical next to it or credit next to it. They changed the words. The bear call spread is a call credit spread. They used to say credit in there. And then they give you a list. If you're getting the free version, they give you a list of some stocks and they give you the strikes. It'll fill in here in a minute. They give you the stocks, they give you the strikes. What I don't know with bar chart is what they use as the justification for the list or what they use for what strikes they pick. Because sometimes I feel like the bar chart strikes are super close. Like, why are y'all right on current price? What is this all about? Are they going with the trend? Are they going with the delta? Are they going with, I don't know what they're going with. So this is something you don't get to ask here. And it doesn't tell you up in here what helps them pick. Like what makes them pick the strike for you. They don't tell you that. But we've used bar chart for a long time. We did use bar chart all the way up until we found something a little bit better, which I'll share that in 1 second. But these are the stocks that show up on the credit spread. They give you the stock, they give you an expiration. And the other thing about bar chart, they only give you monthly expirations unless you're paying for it. If you pay for it, then you can get weekly. But I think it's like $199 a year. And I paid for it one time. Then I was like, I didn't use it enough. So I let it be. They do give you the strikes that you can use, right? They do tell you those and what you're going to take in premiums and all that good stuff and what your percentage of profits. And they give you all these things here. Again, I think this is great for bar chart. It's a free service on this one page. If you want multiple pages, then you have to pay for bar chart. If you're good with the one page, then, you know, you can use bar chart. What we've used though more recently is Peakbot. And everybody who follows me knows I am a Peakbot affiliate. Peakbot has what's called alerts. Peakbot alerts, and they're $5 a week is the Peakbot alerts. And this is what they give you, which I think is a better. First of all, I know the guys who create and designed all this stuff so that I can ask all the questions I like, which is a good thing. I got the people, I know where they're coming from. But they give you a top 10 list of credit spreads, a top 10 list. I did a video on my YouTube channel about using these alerts. So if you want to really see how do you use these alerts, I did a video on my YouTube channel. Jamie, if you're still here, will you go grab the video, the links for the 2 videos that I did talking about Peakbot alerts? Will you go put those in the chat for us? So they give you the top 10 here. And if none of these suit your fancy, you're like, I don't know if I like any of these, then you can pick the full watch list, right? You get full access to all of this. And this watch list updates every 5 minutes. So whenever you want to look at a trade or trend spreads, or this is based on the trend, first of all. So if Carvana has a bullish trend, then they're going to suggest a put credit spread. If AMD has a bearish trend, they're going to suggest a call credit spread. And they give you the strikes. They give you the strikes. Now, I don't check the same strikes like for this with Carvana. I wouldn't go 150, 162. That's a 12.5 spread, which is $1,200. Nope. I go 150 and I go up one more leg, which would be 152.5. I make it just one strike away. That's how I do it, right? So I would do 68, 69, right? I wouldn't do 68, 80. I would do 73, 74. Right? This way I can do my own one more leg. That's how I do, that's how I use the alerts, and that's all mentioned in the video. So that's the credit, the credit spreads that come with this. Again, you can do the full watch list and it scrolls and see all the stuff you want to see there. And then I was mentioning to you that we do the iron condors. They put this out. Let me delete these things so I can see. They put this is also part of the alerts. It's for all those indices that I was just talking about, right? And they give you, this is an iron condor. And let's say we're looking at triple Q, they give you the sell leg for the put credit spread. So you got 458, 459, and they give you the sell leg for the call credit spread, 467, 468. And they're saying you're going to probably receive about $43. These are entered around 12 noon. They suggest around 12 noon, you enter these, and this is manual entry. This is not happening for you, it's manual. And they give you the expiration date, and they give you the how much money it's going to take, and all those good things are all here. This comes, again, this also updates all day long. So you can decide what time of day. If you decide I'm in the morning, I want to get on in the morning, you can. Or if it's 3 o'clock and you say, I think I want to get in for something for tomorrow, you can do that here too. You don't have to do the iron condor. You can do one side. The reason I like the iron condor is because, let's say for this one, you take in $52. You take in $52 in premiums. How much is that in collateral? If I receive $52 in premium, how much am I putting up for collateral?
48.
$48. So my max loss is $48. It's basically a 1-to-1 risk to reward. I like that. You know, I'm getting into this, and they're going to give me $50 right off rip, and I'm only putting 48 of my dollars up in buying power. And the next day you close this trade, maybe you close it for $20. And that means you kept 32. You close it for $30. That means, you know, you kept 22, right? That's how I use the alerts. And I do use the alerts on a daily basis. That is from Peakbot. I do have a slide here that tells us where to go for the alerts. Jamie, are you still here? SPX is here too. Yeah, SPX. Actually, what I like, usually when I do it, because I enter them separately, I usually take in about 250. You take in about 250. So, thank you, Jamie. I take in about 250, which means, again, 1-for-1, 250 in collateral means 250 in max loss. And then even if you close this, if you buy it back for, you know, $200, you've kept $50 in profits. Or you buy it back for $150, means you've kept $100 in profit. And this is from day to day. Now, what's required is you're going to have to put up the collateral piece of it, right? You're putting up the collateral piece of it, but this is each day. You're entering one day at 12 o'clock and you're exiting the next day in the morning. Those actually, you should put your close orders in like first thing in the morning. I usually do it before the market opens. And if one side closes first, I'm fine with that. And you have to watch the other side so that you make sure that you get your, let the price do what it's going to do. And then you close it where you're comfortable closing. Okay. I'm a fan of the alerts. I like the fact that they're based on the 50 period EMA. They're based on the 30 delta. I do know exactly where they're getting those numbers from. I know exactly where the numbers are coming from.
So quick question about
okay.
Peapod.
So Peapod has, I just mentioned the alerts. I'll go to the alert screen. Go ahead.
So I've been trying to follow really quick, and so that enter the next day, like enter the noon and then exit the next day. That like allows you to follow the PDT. Is that correct? Like if you're
yes,
okay,
that keeps you from pattern day trader because you're not closing the same day.
Thank you.
Yep. Enter today, exit tomorrow means you don't have to have 25K. You're not going to get pattern day trader. You're going to let it go the rest of the day and you're going to close it the next day. Okay. Alerts. Use peakbot.com. Jamie put the videos in the chat for the trading with the alerts using the indices part, using the SPX, SPY, those, and using the trend spread. He put those videos into the chat so you all can grab those and watch them afterwards if that's something that's of interest to you. The alerts is stock trend, suggestions, and strikes. I like the fact that you're going to get really decent premiums and the bot or the algorithm is looking for the trend. So it's going to suggest based on the trend, the 50 period EMA. That's what's helping that bot suggest the trend, whether it's bullish or bearish. And the strikes are based on the 30 delta. It's around the 30 delta, somewhere right around, is maybe a little bit less than 30 delta is the strikes that it's going to suggest for that sell leg. Okay. Iron condor strikes on the indices, SPY, SPX, Triple Q, NDX, XSP, and IWM. Right? Those I see lots of opportunity there. Alerts.usepeakbot.com. Now it's been a little rough a little bit the last couple of days because of the fact that the market has been trending in such a way. But I've also found that if I relax, because in the morning sometimes it can be a little nerve-wracking because the price is moving hard and you're like, no, where are you going? But if it goes past 1 o'clock, usually you see something happen where you can decide whether I need to go ahead and close or can I wait and let the premiums draw down and I still will leave with a profit, right? Enter again every single day though. Enter every single day because you're going to take in another $50 per spread or $250 per spread. Keep entering that way. It'll overarch as far as the money. There's more consolidation days in the market than there are trending days. So you're going to, even if a few times it happens where you end up getting breached, over the course of time, you're still going to come out profitable. It's not going to feel, if it's, happening, if you get breached a couple days in a row, you're going to feel a little bothered by that. I know I was, but as you continue to trade it, you'll be able to see that it does level off and move you into profit. And it may not start off in the negative. You might start off in the positive. You might not even start negative. Okay. Peakbot also offers automated trading of credit spreads. The same trend spreads we were just looking at. Peakbot also offers that automated, which is hands-free, which is where all you do is you pick the stock. The bot then enters and exits for you. The bot enters and exits for you. You just pick the stock. Why did I feel like, okay, there's nobody who's waiting to get in, okay? So you pick the stock you want. The bot enters and exits it for you based on each week. And it enters on Fridays or Mondays. And it'll actually enter on Friday, Monday, or Tuesday. You don't get as good of premiums on Tuesday. I like entering on Friday because the theta decay helps the trade go better, go down faster. I work with that. So the bot will do the work for you though. So if you're like, I don't want to have try to remember all these different pieces, I want to understand the strategy and then let the bot do it, that the automated trader do it for me, then go with that. It connects to Schwab, Tradier, and Tasty Trades. So if you have either one of these brokers, you can look at automated trading. Use peakbot.com/E2T. And if you need somebody to walk you through it, we can connect you with Dylan and he'll have a call with you and talk to you about, basically gives you a whole walkthrough of Peakbot. How does it work? And make sure that you get started with that. Okay. Peakbot. I say it so fast. People are like, what's Peakbot? Peakbot. I'm not sure where they got the peak from. I know what the bot, but the peak, anyway, their slogan is welcome to the peak, or see you at the peak, I think is their slogan. Automated trading with them, alerts with them. I use both. I'm an automated trader with them, and I use the alerts for my other trades. I do both. All right. So if you got questions, we can answer those as well. There are other people in the community who also do them. It's not just me. Okay. Leveling up does take some isolation, separation, and some extreme focus. And you starting what you've been putting off this year. Some of us have traded and you've not gotten profitable and you can get a little frustrated because it's not going the way you want to. I suggest that you find one strategy that you can work with, that you can rinse and repeat, that you can use regularly, that doesn't require a lot of watching, doesn't require a lot of collateral, doesn't require a whole lot of stress and perfect entries and exits. I'm a buyer of options as well, and I know what that entails. I know what buying entails. If you don't hit it just right or you don't exit, you got a whole trade is going good, you step away and you look back and your money's gone. You're like, what happened? Price don't hit a resistance and drop back down. And you're like, but I was at 30% and now I'm down 5. What is the deal? I know, but it doesn't work that way with selling. Doesn't work that way with selling. I'd like for you all to continue to join us if you'd like. If you want to keep hanging out with us, there's a thing that says what's next. I must have skipped over that one. Anyway, the E2T membership is where we are all the time. That's where we basically have continued support as you continue to earn while you're learning. We got daily access with me and the team and all. Weekly training, monthly coaching, all that stuff goes together with the membership. We are a welcoming community of people. We love to have folks. We like to hang out together and we have a good time together. And we have an exclusive Telegram group that is there for, I'm there, Jamie's there, our people are there. We're hanging out and helping along the way because trading can be lonely. Trading can be lonely. You can join us there if you'd like to continue to hang out with us a little longer. educator2trader.com. If you want to keep hanging out with us, you definitely can go and do that. All right. I want to make sure that there's no more slides in here that I have missed. Anybody got questions? Anybody got questions?
So a buying question is it safe to say that if you're buying, because you can still exit at any point, right? You can still exit at any time. Is it safe to say that in terms of you want the movement to go up, can I use my ATR as that, next movement? So if something is around $4, it needs to move a minimum of $4 upward. Or should I have had, I think the difference with buying is you've set you set that strike price of what it's supposed to get at beforehand, correct?
Or you're picking a strike price that is close, you can get as close to at the money as you can get, as you can afford to get.
Mm.
Okay, you want to get, so if, so, you know, it's gonna, you know, few things, your pocket, of course, is going to matter. But you want to get as close at the money as you can possibly get. Which is why you look at debit spreads a lot, because if you're trading something that's expensive, you're going to want to, if you do debit spreads, it won't cost you anywhere near as much money, but you can benefit from the move better.
I'm sorry, yes, I'm talking about debit, not to do a single leg, yes.
Oh, well, debit spreads, yes. You want to get, but I try to get as close to at the money. I usually get at the money like one or maybe no more than 2 strikes away if I'm doing debit spreads, because you don't have to.
Oh, so just the next leg, really? I mean, just the
Yep.
next strike?
I do, because if you're buying, you can, I mean, if it's a 2.5 spread and you're going to spend $100, that means your upside is $150. So, I mean, of course, you can go further. You can go to spend $50 and your upside is $200. You can do that too.
So that's what you mean by the amount that you can afford to spend. Okay.
Yeah.
Gotcha.
Mhm.
And then the other thing with like the automation, doesn't that come out at noon? Am I correct? I thought it was.
What, the alerts?
Yeah.
The alerts are available all day and they're updating all day. They send you a message at noon saying the alerts are ready, go look, but those, you can look at those alerts any time of day. That whole trade sheet is available all day and it's updating every 5 minutes.
So even after 3:30, it's still updating?
Yes,
Oh,
it
okay.
updates all the way up. Like the other day, the last update was like 3:52. So it's updating all the way up until just before 4 o'clock.
I thought it was a noon thing. Okay.
Noon is when they're saying, that's when they definitely say to enter those iron condors is for or noon, but those alerts are, that whole watch list is ready all day and updating all day long.
Yeah, I have a question.
Yep.
Okay. I'm just trying to make sure I understand this. In order for you to do the bots, the automated bots, you can only place them on in 2 or 3 times a week. Or did I not hear you right?
Okay, so if you're doing the trend spread bot, those trades are entering on Fridays, Mondays, and Tuesdays. That's when they enter. It enters on Fridays, Mondays, and Tuesdays. So the optimal entry is on Fridays. If the bot is doing it for you, enter it on Friday and it's going to, you looking to close it Monday or Tuesday. If you don't enter on Friday, it'll enter on Monday and it'll close a couple, you will probably look to close it. If you're closing it early, a couple of days, it's set to expire that following Friday or that Friday. It's set to expire and the bot will close it for you and all those things. I generally close my own, but the bot will do it for you. So,
Oh, you can still close the bot though?
oh yeah, you can close the trade because you still have full control of your platform. So all the bot does is enter the trade, and when it's time, it will exit the trade. It does not take over anything.
But what if it's a good, like say the price or your whatever you take home is at an optimal place? Will the bot know to get out?
So
Does
if
it
you
make
get
sense?
to the place where you are ready to get out, then you exit it on your own. You go to your platform and you pick your 2 legs like I just showed you, and you would close it on your own. You don't really tell the bot, go close it.
Okay.
The bot's going to close it on Friday. If you want to close it earlier, you have to manually do it.
Do you know anybody that's used it and has had success with it?
I
But
use it every week. I've been using it for months.
oh, okay. Well, I just assumed you was doing your own all the time.
I was for a long time, and a lot of the times I still do. I'll do the alerts and I do the automated, but I have it, it's automated for me now. What I do is I'll close them on my own usually, but the bot enters many of my trades on it. The bot does the entry and I do the
Okay.
exit.
Does it like, okay, because you know how you say that the stock what I'm trying to say, you got the it has to equal $100. What I'm
Okay.
saying is, do you still have to have that collateral up front for the bot, or do
It has
you
to be
just enter?
available. Yes.
Yeah, okay.
Yeah.
That's what I wanted to make sure.
Yeah. If the buying power is not available, the bot won't enter the trade. It won't override the system. The system, I mean, because like Schwab won't enter a trade if you don't have the collateral or you don't have the buying power. It'll just reject it. The bot will still do its thing. The bot will still try to enter the trade, and then it'll just get rejected by the broker.
Okay.
Yeah.
This was nice.
Any other questions we got? Stacy says, I really want to learn this. It's a lot of practice. Yeah, nothing's wrong with the practice. I suggest you practice anyway, using your sim, using your paper trading till you get comfortable with this. And it takes a few steps. It's going to be a few steps.
Can you paper trade on the cash account?
Yeah, I mean, you can paper trade as long as you have Schwab. Now,
Oh,
spreads require a margin account. So you have to have a margin account to do spreads.
oh, okay. I just flip over. But I mean like paper trade. You still have to have you still could only do it on the marginal account.
Yeah.
Okay.
Yeah, you can do both. Let me find Dylan's number and then I'll put that number in the chat. Let me see. What other questions? Nine, 973-459-1016. I believe that's his number. Oh yeah, you can go ahead and upgrade from the alerts to automated trading anytime you're ready. Absolutely. Make sure that you use the link that includes educator to trader. Okay. Anything else? Go ahead and say in the chat if you have found great value in this training, or if it gave you what you were, if it gave what it's supposed to have gave, put a 1 in the chat. If it didn't quite give you what it was supposed to give you, then put me a 2 in the chat. And if this was a waste of your $97, put 3 in the chat. You're like, this was a waste of my money. Put 3 in the chat. Ah, wonderful, wonderful. It's a good review. Must review the film. This was a great compliment to the live options 411 course. Yeah, it helped to bring everything together. You're welcome. Everybody's welcome. Never hurts. I think every time we go through, I've listened to so many charting calls and watch calls, and then as soon as somebody says something, I'm like, that's something fresh for me. Great info. Mrs. Scott said have to watch the replay. We'll definitely have the replay available. No questions asked. Oh, I didn't ask this question. Is anybody here because somebody else invited them? Somebody recommended that they come and they signed up. Is anybody here who got the recommendation from someone else and they signed up? I want to make sure that I pay affiliate money to whoever deserves the affiliate money. Is anybody here because somebody else in my community or somebody else told them to come and they signed up as a result? It would be nice if everybody found me through me. That means my little marketing stuff works, but I do like word of mouth too.
AP, I found you through Impact, so I don't know if that counts.
Well, I don't know if anybody in Impact can get the money.
Okay. Okay.
Shine, good to see
I
you.
just want to give them their credit.
Thank you. Good to see you. Y'all know we rocking with Impact. So those of y'all who watched our call Friday, Impact is a nice little community where we've kind of partnered up a little bit. They're mostly buyers and education, and I'm a seller with education, and all of it together makes us all stronger traders. All righty, so I want to thank you all once again for spending your time and your money with your girl, Arlissa. We're going to stay green in these streets. Yes, we're going to stay green in these streets. Yes, you got all my social media links there, almost all of them. TikTok, I'm also on TikTok as Educator to Trader. Options Trading for Beginners on Facebook, that's the group. Follow me, Educator to Trader, on Instagram. Of course, join and subscribe to the YouTube channel. And if you want to hang out with us in the membership, you're welcome to do that at in the membership. You can go educatortotrader.com is where all of my stuff is. Stacy says I'm here because of Jamie mentioning you. Okay, I'll make sure that Jamie gets his money so that way he'd get his affiliate monies. That'll be wonderful, wonderful. Okay. If all hearts and minds are clear, if anybody's got anything, any last minute comments or questions, please ask away. Otherwise, we'll shut it down and start to upload this so we can send out the replay link. Anybody? All righty. Well, thanks again for hanging out with us. Everybody go forth and have a really good weekend. I'll be on tomorrow evening at 5 o'clock, live at 5 on YouTube every Sunday, where we talk about the upcoming stuff in the market and what we see coming up. We do that on Sundays on YouTube, live at 5. All righty.
Thanks, Lisa.
I'll see you all later. Goodbye, everybody.
Thank you.
Goodbye.